revenue and earnings growth, beat the number that everyone else thinks there's going to be. So there's a real case for those stocks right now, particularly in a low rate environment. The idea that you're going to get 3% guaranteed dividend is very, very attractive right now.
David, just to recap some of the headlines, we had Bank of America CET1 ratio coming in at 11.9% at December 31st, 2020. David, is there a worry that, even if we have stimulus, at some point the stimulus will end, how many companies will go bust, and how much will that hurt the balance sheet of a lot of these Wall Street banks?
So this is the issue with the stock market that concerns me a lot. The market is thrilled about the near term because the likelihood is we do get a large stimulus. That's got to be positive for companies and short-term earnings, because consumers are going to spend all the money, particularly those in need, so they have 100% propensity to spend. The question is what happens after the stimulus?
Yeah.
And particularly then if we have to, basically pay back that money by raising taxes, because, the government didn't come up with that money. It's really from taxpayers. So really after 6 months or so, that's where the market, the rubber meets the road, and the market has to decide, is the recovery sustainable even with the payback of higher taxes, more regulations, and what rate will the economy grow? So that's where, you start differentiating. As I said, I do think growth stocks are going to have more of an issue if rates increase. That almost is de facto how you value growth stocks. And then the cyclicals, it really depends how fast the economy recovers. As I say, buying a company like Bank of America with a high dividend, even with a lower growth rate, but at very low valuation, the risk is relatively low. Credit quality, which is, I think, your real question, has improved greatly. And it really depends whether we come out of this recession, in decent shape or not, even if it is a slow recovery. But we do think credit quality is going to hold up.
This has been wonderful. David Pearl, thank you so much, and particularly for your comments there on the Bank of America. The yield there, 2.18%, with a little bit of an equity lift this morning. We'll have those earnings for you. And again, a stunning statistic from David Pearl, his view that it's a 10% cash-on-cash return, putting in share repurchase and dividends, use of cash, which Epic Investments is, of course, acclaimed for. The headlines are out again: a dividend, a share repurchase, and again, a pickup there, a mop-up, if you will, of executive and bank compensation in lieu of shares. So you'll see some shares bought back as well to cover up the equity payments that have been made over the recent quarters and years. Coming up, Alan Blinder, the former vice chairman of the Fed, I should say. Alan Blinder on Secretary Yellen. Futures advance up 29. This is Bloomberg. Good morning.
Y lo más increíble es eso, no solo estás sintiendo frontalmente, sino que en la espalda también, entonces a lo mejor estás jugando y sientes que por detrás te pasa algo, entonces...
Y ver cómo te tiran algún objeto o cómo notas la sensación, ¿no? Como que te golpean a ti. Yo creo que hace que empatices mucho con los personajes y que sea todo mucho más real.
This is Bloomberg Surveillance. I'm Karina Mitchell with the Bloomberg Business Flash. In Europe, car sales fell the most on record last year. New vehicle registrations plunged 24%. Relatively resilient demand in the second half of the year only did so much to make up for the collapse during the initial coronavirus outbreak. And the social media network Parler has reappeared. The platform was briefly the new home for some of President Trump's supporters who flocked to it after Twitter banned the president. But Parler became unavailable after Amazon determined it had violated its terms of service. Now it's found a new company to host it. According to tech news site Ars Technica, it's Russian-owned DDoS Guard. And that is the Bloomberg Business Flash. Tom.
Karina, thanks so much. Equities, bonds, currencies, commodities, a lift and a persistent lift through this morning on futures up 29. The VIX comes in 1.76 points. Nice tone to the market, 22.58. And yields expand out, up 1, up 2, up 3 basis points, 1.12% rounded up as well. I'll mention again oil, 55 a barrel. Francine?
Yeah, Tom, I also had oil. If you look at crude oil and emerging markets, they're advancing. Global markets climbing ahead of Treasury Secretary nominee Janet Yellen's confirmation hearing. Then the other thing that we need to spend a bit of time on is the London Metal Exchange may propose permanently closing its open outcry trading floor. Up next, we speak about COVID-19 with Dr. Amish Adalja, Johns Hopkins Center for Health Security Senior Scholar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keynes in New York. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we bring you insight from experts in public health, infectious disease, and emergency preparedness. Well, joining us now is Dr. Amish Adalja. He's Johns Hopkins Center for Health Security Senior Scholar. Thank you so much, Professor, for joining us. When you look at the rollout of the vaccine, a number of questions on whether the U.S. and other parts of the world, including Europe, are too slow. What can you tell us about what you're actually seeing on the ground?
It is something that's very slow. It started with kind of a trickled pace at the end of December, but it is starting to ramp up. And I think it has to do with a lot of logistical issues that states were very wary to really jump ahead quickly, not knowing what their supply chain would be, not knowing what the percentage of people who had allergic reactions were, and really trying to stick to the priority groups as best as they could. And I think that's sort of served as an obstacle. And now we're seeing them get much more flexible and comfortable doing it. But again, we're still far behind where we need to be. We're not at the rate of Israel. We're not at the rate of the UAE. And I think if we're going to stay ahead of this new variant and put this pandemic behind us, we have to significantly ramp up the speed, and we have to have a lot of security around how many doses are going to come, so that states can safely give people doses because they know more are coming, so that they don't have to continue to kind of start and stall.
What can you tell us about, the vaccination rollout and the fact that we could still see, even if you're vaccinated, asymptomatic infections?
This is a bit of a controversial topic in my field, and we're trying to understand the answer to this question. We know the vaccines are very effective at preventing symptomatic disease, and they likely reduce spread. But how much do they reduce spread? Is it 80%? Is it 70%? Is it 60%? Because that's important for the guidance that we give people after they're vaccinated. So right now, if you've gotten 2 doses of vaccine, we don't change the guidance, but we know that those people are less likely to be asymptomatically infected, but we don't know how much. And I think this is an urgent need to really do research to understand how protective are they. And many vaccines do protect against not only symptomatic infection, but asymptomatic infection. And the other point is, as more people get vaccinated, it becomes less and less important about this asymptomatic infection, because the virus is designed to stop severe disease from occurring. And if everybody is protected, even if they get an asymptomatic infection, it's not going to matter, because no one is going to land themselves in the hospital with COVID-19. But again, this is something we have to figure out so that we can give people the right public health messaging.
Yeah, in the UK, I mean, the experiment seems to be you vaccinate as quickly as possible with the first dose, but you actually wait up to 12 weeks to give the second dose. Is this as reliable as the trials in which actually the 2 doses were much closer?
We don't know, because there was never a trial where they waited 12 weeks. All the trials had this 3-week interval for the Pfizer vaccine and the 4-week interval for the Moderna vaccine. We do know that if you get your second dose, then you're going to get the protection. But how long will that first dose's protection last? So as you get closer to that 12-week mark, do you have much residual protection from the first dose? And that, I think, is also another question. We don't have data. I understand why the UK did it, and I do think taking the second dose late is better than not taking it all. You don't have to restart the series if you take your second dose late, but you're going to have some period of time where you're probably not as protected as someone who got their first and second doses on time. But in an emergency situation, I think we can't let perfect be the enemy of the good. And if this is an issue of trying to stay ahead of that variant and try to vaccinate as quick as possible, I think it's a reasonable approach. But I would like more data to be able to be confident that it's not going to have any deleterious effects.
Thank you so much for joining us, Dr. Amish Adalja there of Johns Hopkins. Be sure to check out VRUS Go on the Bloomberg for the latest information, and you can also tune in every day for our exclusive conversation with Johns Hopkins experts for an inside look at battling COVID-19. Now let's get straight to the Bloomberg. First Word News, here's Karina Mitchell. Hi, Karina.
Okay, Francine, good morning again to you. Janet Yellen will have a different task than she's used to when she goes before a Senate committee today for her confirmation hearing. Joe Biden's pick for Treasury Secretary will defend the president-elect's $1.9 $1.9 trillion stimulus package. Yellen is expected to tell them that low borrowing costs now mean it's time to act big. She's a former Fed chair who spent years defending central bank thinking and actions. Meanwhile, Joe Biden reportedly will propose a comprehensive immigration bill on the first day of his administration. According to the Associated Press, it will include an 8-year path to citizenship for roughly 11 million people here without legal status. That is, of course, a massive reversal from Trump administration policies. And the Biden administration has rejected a move by President Trump to rescind travel bans on non-American citizens arriving from the EU, UK, and Brazil. The bans are aimed at preventing the spread of coronavirus. President Trump said the bans could be eased safely, but Biden officials say they plan to strengthen public health measures around international travel. And over to Italy, Prime Minister Giuseppe Conte faces a crucial test today. There's a confidence vote in the Senate 1 day after he won a similar vote in the lower house of Parliament. A narrow win in the Senate would allow Conte to stay in office, even if his support falls short of an outright majority. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Francine.
Karina, thank you so much. Now, coming up next, we speak with Gerard Cassidy, RBC Capital Markets Head of U.S. Bank Equity Strategy. We're expecting a bit more news, of course, from Bank of America, and then a little bit later on is Goldman Sachs. This is Bloomberg.
Continues to be, recovering well. And with the opening up that was decided at the last 5-year plan, that is a golden opportunity for many international banks.
So we'll look to double our footprint across IB and also wealth management and asset management in the 3 to 5 year time frame.
Growth outlook structurally is very strong. But it does need to consolidate and allow time to help the share price appreciation to move more in sync with the growth.
So China can avoid further decoupling if they stop these inappropriate actions.
But at the moment, we really want to see the dust settle first on international relationships, on China's role in the global economy.
I don't see a likelihood of a big change in the policy with the change of administrations.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Keene in New York. Of course, we're looking at the politics of this nation, the impact worldwide, but there's also, well, bank earnings. They are out with a vengeance last week. Gerard Cassidy is going to join us with RBC Capital Markets, really to take a look. I want to look at the 4 relative performances of the banks. But first, on the global Wall Street and the American banking ballet, Shanali Basak joins us, our Wall Street chief correspondent. Shanali, Mr. Pearl of Epic Investments says with the share buyback, Bank of America, and frankly, many of these banks have a dividend power, a shareback power, and he used a stunning statistic. They start the year with a 10% cash-on-cash return. Do they really have that much cash?
They have a lot of cash, and you saw that in the press release this morning. Bank of America put out before their earnings an all-time high of 11.9% in their CET1 ratio.
What is a jargon? Hello, it's Monday.
They're saying they're safe.
What is a CET1 ratio?
They're saying they have a lot of money on hand. The question is, you know, we're facing a Yellen testimony here. All of these banks want relief so they can keep lending, they can keep buying back stock, and they can keep returning dividends to shareholders. They have the money after a global pandemic. How do they use it?
Is there a stress test that's involved in this that proves that they're that solid? I mean, does someone outside have to say to Mr. Moynihan, go ahead?
Well, you know, the banks have been stress testing themselves harder than the government has been these days. And what they'll tell you is that last March, they went through a real life stress test, which could have been harder than anything they would have ever gone through. But with that said, Tom, I don't think just financial health is the issue here. It's financial profitability. They still are facing a lot of pressure on that net interest income, which is what people are looking at. And Bank of America has a lot of their business tied to the health of the consumer. So can that consumer stay strong through this choppy year?
Shonali, good morning from London. What are we expecting them to say on outstanding loans?
So we want to see them also build those reserves, release those reserves, just as JP Morgan has done, just as Citigroup has done. If there's any weakness on that front, if they can't say that they have the same expectations of the economy that their two peers have had and Wells Fargo has had, then we're going to face a lot of questions ahead, and we're going to see that weigh on the larger sector.
I mean, what else are we expecting from Bank of America? Is it about expenses, whether they can cut that more, or net interest margins? Is there anything particular that Bank of America that could be different from some of their rivals?
It's great that you brought up expenses here, because Bank of America is a rare bank to have said that they're not going to cut jobs at all in 2020. Now, what does that look like in 2021? Are they feeling like JP Morgan as well, where they can be investing in technology? Do they see any acquisitions ahead? Are they going to invest in branch networks? We've seen branch networks across America really decline at a record last year. And is Bank of America going to keep up that real estate footprint across the country?
Shirley Bassick, thank you so much, and we'll continue here as we look for those earnings to come out. What is it, 4 minutes away? Right now, Gerard Cassidy with us, RBC Capital Markets. He's got the advantage of the hindsight of JP Morgan and the rest as well. Why is Bank of America different than the others? What is the Moynihan distinction?
The real distinction between Bank of America from Citigroup and JP Morgan, for example, who both reported on Friday very good earnings, is that over 90% of Bank of America's revenues come from the United States. As you know, Tom, Citigroup is around 55-60% come from outside the United States. And then in the case of JP Morgan, approximately 75% of their revenues come from the United States. So Bank of America is a really true reflection of what's going on here in the United States.
It's a consumer reflection. Shirley Bassick mentioned to me, Gerard, that the consumer front of Bank of America as well. Does Bank of America project abroad as JP Morgan and Citigroup desire to?
I think that's a fair assessment, that Bank of America is definitely penetrates more of the consumer here in the United States. JP Morgan Chase is very close to that, Citi much less so. But yes, Bank of America, not only the consumer, Tom, but also small business borrowers. So it's a real pulse of what's going on in the United States.
So, Gerard, good morning from London. What do you think it will tell us on household spending and household saving?
Francine, I think what you're going to see is that the household saving numbers here in the United States are still quite strong, and it's extraordinary when you consider what we've just been through with the pandemic. On the spending numbers are also should show an improvement from where we were over in the summertime. But we're still not at normal levels, and I think that also will be talked about, that we still need to see a continued recovery in the economy to get consumer spending back to normal levels.
I mean, what kind of spending? Is there anything that we can actually see now in trading to give us an idea of how these chief executives are expecting markets to do?
I think what you're going to hear from Bank of America and Goldman Sachs today is that they're both going to put up, particularly Goldman Sachs, very strong trading numbers, as we saw with both Citigroup and JP Morgan on Friday. In particular, the equity trading numbers from both those companies were very strong, and I expected to see the same from Bank of America, Merrill Lynch, and of course Goldman Sachs. And they both on Friday, the companies that reported, both indicated January has started off quite strong. Now, granted, we've only had about 10 trading days in January. It doesn't make a quarter, but they've been very encouraged with what they're seeing so far.
Gerard, what is so important here in looking at the chart back to 2007, JP Morgan truly stands alone versus the other three major banks, Citigroup, Wells Fargo, and Bank of America. Obviously, Mr. Moynihan's been on a roll. He has a breakout now. Is he breaking out to a lower trend than JP Morgan, or can Mr. Moynihan even hope to get the share price excellence that we've seen out of JPM?
It's a very good observation, Tom. And I would say that this downturn is going to demonstrate to investors that CEO Moynihan at Bank of America really was able to navigate through the downturn very effectively. And that's what makes JP Morgan stand out. The 2008-2009 downturn, they navigated that very successfully under the leadership of Jamie Dimon. And I would point out that Bank of America and Citigroup did not. And I would suggest that both those companies today, particularly Bank of America, really have demonstrated that they have changed their stripes. And there will be, I think, a narrowing in the valuation difference between JP Morgan and Bank of America over the next 2 to 3 years as investors recognize that Bank of America got through this downturn quite effectively.
Right now, the earnings come out for Bank of America. Gerard Cassidy with us with RBC Capital Markets, and Shonali Basak looking at the 47 press releases as well. Francine, I'm going to have real trouble with a fourth quarter first look of 59 cents versus 74 cents. We're going to have to go beneath those numbers.
Yeah, we are, and of course they're coming in thick and fast. So we're looking at the Bloomberg terminal just for any more insight into how we break it down. Again, that fourth quarter net income 5.5 billion or 5.5 earnings per share is of 0.59. Jared, I want to go back to something that you just said, which is basically how they performed in the downturn. But does the downturn for actually banks, Jared, not come when there's less policy support from central banks? And what do those banks look like then?
Francine, you really put your thumb on the $64,000 question. You wonder if a Pandora's box has been opened with the federal government's and the Federal Reserve's aggressive action during this downturn, which was unprecedented. So in the next downturn, will politicians demand similar action? And can we maybe, and this is way putting the cart way before the horse, but could the banks be really turned into financial utilities because of that Federal Reserve put and the federal government put? But you're right, the actions by the federal government and the Federal Reserve during this downturn, I think one of the unintended consequences was that it really made it better for the banks on credit, as we've not seen the consumer delinquencies that you normally would see when the unemployment rate goes over 10%. We just haven't seen them.
I want to give Bank of America credit for what they've done here with these releases, folks. They bring out these releases, and within 30 seconds, I've got some wonderful anecdotes of how the bank is. Gerard, you have been a leader in the shift to digital banking. Here's one statistic. Zelle volume, which is where I send money to Shonali. Zelle volume grew 80% year over year. I mean, with the crisis, the pandemic crisis, digital is here. Is Bank of America the best digital platform in banking?
Tom, Bank of America is clearly at the top of its game when it comes to digital banking. I'd include JP Morgan Chase in there as well. But Bank of America clearly, as the numbers you just quoted show everyone, that they are at the cutting edge of digital banking. And digital banking was really making its move prior to the pandemic, as we all know. but the pandemic brought more people into the digital channel, and I think you're going to see this number just only increase going forward.
Sonali Basak, looking at the numbers here, what do you see, Sonali?
On first blush, not surprising, net interest income down 16%. We're going to want to know how much that's going to weigh on them this year, Tom. We're also seeing fixed income trading fall in well below expectations. Those are two of the things you can expect really weighing on performance here. They're short. They're short of expectations, which is why you could imagine they would have put that buyback release out sooner, so you can focus on that instead.
Shall do we know why they're short of expectations?
The fixed income trading number, again, that is significantly lower. They did beat on equities trading, which is a good thing. We are seeing very robust activity, but again, we saw Citigroup short on fixed income as well. Are Citigroup and Bank of America losing share to the big three, right? We're going to see that later today with Goldman Sachs and Morgan Stanley tomorrow, but that weakness there is not great in a robust time, Francine.
Yeah, if you look at it, I think the equities trading revenue just coming in better than expected, and also what you're just saying about fixed income seems to be outweighing gains in credit. Is that right, Sonali?
Exactly. We are seeing that weakness there. Remember, the banks here, Tom's favorite number here, value at risk, is going up at the other banks. And so the question is Bank of America saying we want to be more conservative here? We'll listen to what they have to say on the call about that. But again, conservative at the risk of gaining more share. A little bit of a bright side here for Bank of America, too. We are seeing significant increase in deposits, more than $300 billion worth of deposits. Really, that is a place they are neck and neck with JP Morgan. So we are seeing bright spots. But again, this is not a great print for the first blush for Bank of America in a standout year for the banks.
I look, Sonali, at where we are. I'm looking at a fascinating press release, folks, right now. I want to get back to Gerard Cassidy as well. And I think, Sonali, you're brilliant here on the trading is up short. Is it up short, as you mentioned, because they're losing market share, or is it short because they made value at risk trading strategic bets that were off the mark?
And the question
is we don't know.
Do you want to incentivize the banks to take on more risk? That is the question. Bank of America tends to be conservative, right? They are the big consumer bank. And again, that's the tack that they may take. You saw them really meet expectations, really push things forward at the end of last year, Tom, when it came to underwriting, especially of some of the riskier products that were coming to market. But again, maybe they just didn't want to take on that risk on their trading.
It's wonderful to have Gerard Cassidy with us here as we sum up these four banks, Gerard, and it is still about the allure of trading. Have we gotten off the addiction of trading, or is that still front and center, the delta quarter to quarter?
It's an interesting question, Tom, because for certain banks, it is still an addiction. Obviously, for Goldman Sachs and Morgan Stanley, it's a much larger percentage of their revenue than it is for a Bank America, for example. And so I think when you look at the trading numbers, it's more important for the more pure investment banks. But as I was looking through the numbers here, the provision for credit losses was about $53 million. And that's the big story, Tom, for this year for the banks, particularly Bank America. Credit reserve releasing will be very dominant, and that's going to drive earnings. It's going to drive tangible book value per share growth. It's going to drive share repurchases. So as much as people may want to focus on trading, for Bank America, it's all about credit, and the number was very good here for Bank America.
Gerard, how long will that last for? We also hear from the chief financial officer saying that they're ending the year stronger than before the health crisis. And again, I imagine this is in terms of its financial position.
Yes, very much so. You heard earlier about the CET1 ratio, the Common Equity Tier 1 ratio. They're required by the government, by the Federal Reserve, that is, to hold a 9.5% CET1 ratio, and they're well above 11%. So they're in very strong position in terms from capital, and that shows up here. And I think the loan loss reserve releasing, this will last well into 22 as the U.S. economy grows this year and next year.
Gerard, what will Bank of America do with expenses?
I think what you're going to see on expenses for Bank of America is that their expenses will be one of the focus areas to manage for 2021. I think what's important here on expenses for the industry is that they need to obviously reduce the rate of growth, and in some cases, the actual nominal level of expenses. And I think that's what you'll hear from Bank of America today on their call.
It's right where I wanted to go, Gerard Cassidy. Sonali Basak here, and again, with the temperament of Wall Street, more than any of the other banks, this screams expense reduction. I look at the folks, I mean, I can't say enough about the clarity of presentation of Bank of America. Sonali, not once, twice, 3 times, they clearly show blown out efficiency ratios where they got to cut expenses. How do you cut expenses and yet build in the digital we talked about Zelle?
We are in the same vibe here, Tom. Page 12 of this press release, you have a 69% efficiency ratio.
Exactly. That's untenable.
It's huge.
Gerard Cassidy would gray over that.
But, remember what we said, that Bank of America promised not to cut jobs in 2020. Over the long term.
It's not 2020 anymore. Come on.
Not.
Are you predicting layoffs here for Bank of America to right-size this bank?
It is going to be hard not to. I'll say that. However, their decision not to cut jobs in a pandemic year will serve them well when it comes to talent retention, when it comes to reinvesting in their business in the future. How do you balance these things, Tom? Right. Their efficiency ratio a year ago was under 60%. It's close to 70 now.
I've got that's 70%. I never heard that. For Gerard Cassidy, I got a working number of 211,000 Bank of America employees. Where's that number in 5 years?
It's going to be lower, Tom, and the reason being is you put your finger on it, which is digitalization. As this company over the last 10 years has done a very good job in lowering expenses. Under Moynihan's leadership, coming out of the financial crisis, they lowered expenses steadily throughout that decade. And I would expect that to resume now that we come out of the pandemic. As you guys have pointed out, they held off on downsizing any personnel in the pandemic, but now that's changed, and we would expect going forward that you're going to see fewer people, the lower headcount over the next 5 years.
Of the 4 banks, this was the most fascinating to me. Gerard Cassidy, always thank you so much with RBC Capital Markets. Sonali, thank you so much. This is going to be fascinating today to see how they manage the various conference calls forward. Francine, the market, futures up 29, Dow futures up 197, and the VIX 22.60.
Yeah, it's very clear, Tom, that global markets here in Europe, but also futures, but in emerging markets earlier on are climbing ahead of the Treasury Secretary nominee Janet Yellen's confirmation hearing, in which she's expected to call for expansive government action. So I know there'll be a lot of questions on the markets, exactly what works and what doesn't. Crude oil, emerging markets also advancing, Tom. So there's, of course, a lot going on just one day before the inauguration. You look at politics, you look at some of the moves in fixed income. Goldman Sachs also out later with earnings a little bit later. Stay right here with Bloomberg Surveillance ahead, simulcast on radio and TV. Much more coming up. This is Bloomberg.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
It's not bad news is good news anymore. It's bad news reflecting really painful couple months ahead for the economy.
Political risk is a persistent theme here into 2021.
You have all of the telltale signs of a structural bull market at play here.
The stimulus is coming. That's going to help the consumer and small business.
I don't think we should be fearing that inflation is going to be running off to the races.
There's a lot of monetary stimulus coming in. There's a lot of fiscal stimulus coming in, and there's recovery from COVID. It's kind of like a 2009 year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro with equity futures flying here this Tuesday morning. After the long weekend stateside, we disrupt regular programming for Tom Keene to berate me for the next 2 minutes about my absence for the last month. Tom,
oh no,
please
we're going.
Be my guest, take the stage.
It's the theme for January, John. It's got nothing to do for 2 days. No, we didn't miss you. The Green Parrot, Key West, Capri for weeks. We're thrilled you're back, John. Tell us, John, give us one observation of your travels.
Here's my observation this morning, this on Twitter. While we've all missed you, I can't imagine anyone is happier to have you back than poor Lisa Abramowitz. Lisa Abramowitz, how bad has it been?
Welcome back, John. It's great to have you here. I will say, nice try trying to get away with just 2 minutes of being berated, John.
Yeah.
I think it might be the theme for 2021, but okay. I will say it's wonderful to have you back.
I'm prepared.
Let's get right to the heart of the matter, folks, is I can't afford the toaster behind John. I mean, he's got the fancy European toaster behind there. It's got everything but the Dolce & Gabbana motif on, John. Good to see you back with your beloved $400 toaster.
Thank you, Tom.
Looks great on radio.
Let's talk about a $1.9 trillion deal down in Washington, D.C., with Janet Yellen facing her testimony, a hearing a little bit later, Tom. Look, it's all lining up for a big year of stimulus on both the monetary policy side, on the fiscal side as well.
It's really, she says go big. And what's so important here, John, Greg Villiers published this morning, a working number from 1.9 down to maybe 1.5. But the presumption, John, that it's a follow-on infrastructure-like second stimulus. And what will the two sum up with, John? The number one observation, Ambrose Evans Pritchard in the Telegraph this weekend, he sums up U.S. action to 25% of GDP.
Yeah, and UK austerity. We can talk about that a little bit later. Lisa Abramowitz, quite clearly top of the agenda this Tuesday. Janet Yellen in Washington.
Yeah, and I would say the theme for today and for the week is changing of the guard, both with respect to the presidency. Today is President Trump's last full day as U.S. president. People are looking for pardons. People are looking for potential other actions in his final few hours in the White House. But 7:30 a.m., Goldman Sachs fourth quarter earnings, about a half an hour time just to get that out of the way. But 10 a.m., yes, Janet Yellen presents to the Senate for the the Treasury Secretary confirmation hearings. Everyone's going to be seeing how she toggles between this idea of a $1.9 trillion necessary spending plan with the rising debt load. How will she toggle between the idea of keeping interest rates low in the face of rising inflation, in the face of rising debt to GDP, which is set to exceed the highest ever in history, John? These are the issues that people are looking for from her, and she is the first person to ever serve as both the head of the Economic Council for the presidency, Federal Reserve Chair, and she would be the first person to ever also serve as Treasury Secretary.
Let's build on that and get straight to the price action this morning, Lisa. I haven't looked at this for a month. Where are we on the S&P 500? Approaching 3,800. Year-end target over at SocGen, Bank of America, on the S&P 500, year-end 2021, 3,800. Futures this morning up 0.7%. A lot of talk about the bond market, the additional supply. Treasury yields higher this morning, the curve steeper, your 10-year 1.118%. Tom, for me, it's not about supply alone. It's what that supply achieves that matters for this Treasury market. Last year, we had a ton of supply in the Treasury market. Yields were lower. Yields are higher this year. People think they'll go higher still because they think that supply will translate into better growth and a better trajectory going forward. And I think that is what's key as we discuss this bond market and the stimulus down in Washington, D.C.
You know, the ambiguity is there, John, but what is really important is this about the level of yields, 1.12% on the 10-year yield, or is it about the rate of change, the speed, the trajectory towards higher yields? I'm going to go to where a lot of guests have been, John, in the month where you said, I haven't looked at this for a month. Well, let me help you out, John. In the last month, we've had a lot of people put that ambiguity is the rate of change of interest rates, not so much the level.
Well, the level matters for the big banks over on Wall Street. Let's get to the big banks this morning. The earnings, Bank of America behind us, Goldman Sachs in front of us this morning. Sonali Basak has your wrap. Hey, Sonali.
Morning, John. We have Bank of America out, even before earnings, saying it would buy back almost $3 billion worth of shares. So we have some good news here. We have them also facing a little bit of pressure here in their net interest income. They haven't yet provided an outlook for the full year, but that is the one number everyone will be looking out for. They're short on fixed income trading. However, they've been doing very well in investment banking. Bloomberg's own league tables show that they are neck and neck with JP Morgan in a banner year for debt underwriting. So can they keep that up? The consumer outlook is also quite rosy, but we will be looking for Brian Moynihan's economic risks ahead.
Sonali, thank you. We'll catch up with Sonali a little bit later this hour. Goldman Sachs coming at the bottom of the hour, 7:30 Eastern Time. Joining us now is Evan Brown of UBS Asset Management, the head of multi-asset strategy. Evan, let's just start with Janet Yellen down in Washington, D.C. We already know so much already. What are you looking for a little bit later?
No, I mean, I think she's going to be very much endorsing Biden's economic plan, $1.9 trillion. And as we already have the text of her speech, going big at this time of low interest rates, there will be, given Janet Yellen's history as Fed chair and someone who, you know, very much endorses what Jay Powell has done in terms of trying to engineer an inflation overshoot, there is going to be a very healthy relationship between those two individuals, a fiscal and monetary partnership together, because you really need that if the Fed is going to achieve its goals of higher inflation and also much stronger employment. So expect her to be, you know, doubling down on what Biden said last week with the large fiscal number.
Fold in equity dynamics into your asset management choice right now. Is it a dynamics of sustained margin expansion? Is it about outright earning growth, or is it the surprise of revenue growth?
Yeah, I think it's outright earnings growth and operating leverage. I mean, we saw the multiple expansion last year, right? And now it's time to deliver, and now it's time to give guidance about you know, a really strong bounce back in the economy and earnings. But the fiscal is clearly tied to this, right? I mean, if Biden is able to get, you know, another $1,400 of checks and unemployment insurance boosted and extended, that is a lot of money in people's pockets, pent-up demand that they're going to end up, you know, spending once this vaccine is broadly available. So it's going to be quite supportive for earnings and especially for those those companies and sectors that were COVID losers last year and set to be winners this year.
Evan, does the dollar weaken or does it strengthen on the heels of more fiscal support?
So this is the big debate here right now, because it was very interesting that when you had the Georgia elections, when you had the blue wave, everything kind of reacted as you would think so, except the dollar. The dollar did not go down anymore, and we've been broadly in this view that dollar is going to be held down by real yields and dollar debasement, higher fiscal stimulus and current account deficit and the like. But I think the narrative is changing there, at least in the near term, where it's less about global growth weakening the dollar, and it's more about relative growth differentials, just because what we're hearing on the U.S. side is so much more powerful than we're getting in any other country, such that relative growth differential and then, to some extent, relative yield differential in favor of the U.S. is going to be attracting inflows, and the dollar could have a little bit of a rally here on that.
To be clear here, though, Evan, you think that's a short-term story, a short-term call?
I think that's a short-term call. I mean, I think big picture, the Fed, let's not doubt the seriousness of the Fed in their flexible average inflation targeting at all. They're going to do everything they can to keep real yields low. It's going to be tough for other countries to outdove the Fed, right? And so over time, and especially as other countries recover, there's Europe's a little bit behind on vaccines, but expecting a big bounce back when that happens over the course of the second quarter and second half. And so as it becomes a more balanced global growth picture, then you'll get the dollar weakening again. But for now, it's really a U.S. dominant one, and so that's kind of what I would call a counter trend rally in the dollar.
Evan, great to catch up as always. Evan Brown there over at UBS. And Tom, that's the story for a lot of people. Front page of the FT, front page of some of the British newspapers over in the UK. There's talk of tax hikes. There's talks of corporate tax hikes. There's talks of austerity later this year. Janet Yellen down in Washington, D.C. is going to pledge to do none of that, to go big, recognizing the debt story, but ultimately taking the opportunity to look at where rates are, issue more debt, and provide more stimulus. I think it's a mistake in the UK that there is even a conversation on the front page of a newspaper about tax hikes at this stage already, Tom. And that's why so many people are getting bulled up on the idea of the United States compared to the rest of the world.
Yeah, Bank of America, by the way, folks, giving it away right now. I'm going to go back to the efficiency ratio in a moment. John, you're absolutely right. And it's a stark difference between the two. But what's absolutely stunning, John, is when you dovetail it off the pandemic. We're at 400,000 deaths today. John, while you were gone, I did an extrapolation in honor of you. And that extrapolation on 500,000 deaths is in the vicinity of, I believe it was the first week of May. We have to overlay the pandemic on this. John, you missed the American Jobs Report, January 8th. Lisa and I know very clearly that was the worst report going back pre-World War II.
And we expected a weak December. That was the story, Lisa. People were talking about it at the end of November. The beginning of December, Bloomberg Economics came out and called a negative print on the payrolls report for the month of December. Are you going to trade on that? Or are you going to trade on the idea that later this year things get better?
What do you think?
And we've seen the worst of it.
Obviously,
and quite clearly, people are lining up to trade on the latter and not the former.
Right.
And I think that's going to be the story for the next several months.
Well, the hope trade. And the question is whether when the actual fiscal stimulus plan puts a kibosh on that into a reality trade, because people have a sense of what kind of support there will be, John. And that sort of was some of the volatility that we saw last week.
It's good to be back. I have to admit, you guys have taken it very easy on me. You really have.
Oh,
so
far. You brought a souvenir. Folks on radio.
12 minutes.
Folks on radio. You went to Fortnum and Mason and loaded up on tea and walked out with a British mug. I mean, it looks great on radio as well.
Just supporting the economy, Tom.
I'm going to tear up
Tom Keane and
here.
Lisa Bravitt, I'm Jonathan Ferro with Futures Positive. This is Bloomberg.
Tom.
Oh, God.
I'm
Karina Mitchell with the First Word News. Treasury Secretary nominee Janet Yellen is expected to tell a Senate committee that low interest rates mean it's time to act big on a coronavirus stimulus package. The former Fed chair begins her confirmation hearings today. It will be the first time lawmakers can question someone about the Biden administration's $1.9 trillion relief plan. Meanwhile, Joe Biden reportedly will propose a comprehensive immigration bill on the first day of his administration. According to the Associated Press, it will include an 8-year path to citizenship for roughly 11 million people here without legal status. That's a massive reversal from Trump administration policies. The International Energy Agency has lowered forecast for global oil demand. It's cut its first quarter estimate by 600,000 barrels a day. The IEA says the global vaccine rollout is putting fundamentals on a stronger trajectory for the year. Still, forecasters say it will take more time for oil demand to recover. In Europe, car sales fell the most on record last year. New vehicle registrations plunged 24%. Relatively resilient demand in the second half of 2020 only did so much to make up for the collapse during the initial coronavirus outbreak. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
There's
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
We start from where the economy is today. And the truth is we're at a very precarious moment, and the economy and the virus are spiraling downwards. So now's the time to act. We know that this is going to take a lot of work, but we're ready to do it. And as you saw, the president-elect's making the case that now is the time to move forward.
Brian Deese, President-elect Joe Biden's pick to replace Larry Kudlow as the director of the National Economic Council. For our audience worldwide from New York City this morning, good morning to you all. The attention of the world on Washington, D.C., the attention of this market on a stimulus program down in the nation's capital. Equity futures this morning, positive, up another 0.7%. We're plus 27 on the S&P 500, Tom. And this market is inching higher this Tuesday morning.
Well, inching higher, clearly a constructive sign for the president-elect. Look for our inauguration coverage, folks, tomorrow, starting at 11 a.m., but it'll be a major theme for us through the day and into tomorrow morning as well. Kevin Cirilli, our chief Washington correspondent. Kevin, to what Mr. D said there about a precarious moment, let's talk about a precarious Washington, which is away from a remit of economics, finance, and investment. And it's a Washington dealing with something they dealt with forever, certainly back to U.S. Grant, if not back to Washington, he of the military, and that is white supremacy. How will the people you know on Capitol Hill deal with a weekend discussion of white supremacy?
Well, look, there's no doubt that this has now been brought to the forefront in terms of domestic terror groups and how the United States is going to combat those groups. And you know, quite frankly, the presence here in Washington, D.C. of 25,000 National Guard troops is quite palpable to see just how this city has been completely flipped upside down on its head with the result of the presence.
How does it change the first days, rather, of the Biden administration if they are transfixed by 20,000 National Guard in these tangential debates to economics? How are their first days changed?
Well, in terms of what we're expecting from President-elect Joe Biden on the first days, it will really be refocusing his commitment to defeating COVID-19 and trying to communicate to the public what the plan is for America as it relates to rolling out a vaccination in 50 states that many have argued has been botched. And so that's really the focus of the incoming administration and what we're hearing on them. And that's why you saw him last week unveil that $1.9 trillion economic stimulus on a day, quite frankly, the day before he's sworn in and takes his oath, that his Treasury Secretary nominee is set to testify before the Senate.
Well, let's talk about that testimony, Kevin. What kind of atmosphere do you think will welcome Janet Yellen?
Look, Jonathan, I think that she will receive welcome amongst Democrats. I think that Republicans, based on the aides that I talked to, are going to try to glean some more information about her policies in the geopolitical portfolio, especially as it relates to U.S. and China, and even how she would handle different trade deals like Section 230, for example. And so, I think that there are going to be a host of different geopolitical questions, but the main focus will be on her position on the stimulus plan.
And certainly we expect her to support it, Kevin. The question, of course, is how quickly can we get a stimulus plan through Congress right now? And what size will it ultimately be? Where are we in terms of Republican pushback on the $1.9 trillion price tag?
They are pushing back. I was struck by tweets from Senator Marco Rubio, a Republican from Florida, just a couple of days ago, Lisa, in which he said that a piecemeal approach would be a better approach, just pass the $1,400 stimulus checks first and alone. That's not something that Democrats want to see happen. They want to see a bill that's much more all lumped together. But look, you're absolutely correct. This is going to be a fiscal fight, and it's a fight that Republicans are willing to have.
Kevin, let's talk about a strange fight that developed yesterday evening over a travel ban instituted months ago on Europe, Brazil, and elsewhere, and then a slap back, a slap down from the incoming administration. What is going on?
President Trump had said that he is going to lift this ban by January 26th. Obviously, he'll be out of office by then. The Biden administration says not so fast. They're going to keep it in place. It's just another dizzying policy display of where COVID-19, of the differing approaches between the outgoing administration and the incoming administration.
And Kevin, I'm glad that John brought that up, because when you talk about the dizzying policy changes, it has to do with what Mike Pompeo is doing with relation to China. It also has to do with the appointment of Michael Ellis as the National Security Association General Counsel, former Devin Nunes employee. People saying that this could be of concern because this typically is a career employee type of appointment. What's the significance of this, Kevin?
Well, it's quite significant, and I think it's part of a broader debate in terms of whether or not there should be career appointees or political appointees. And the outgoing administration have as is typical, have put individuals on various boards and whatnot, and it's drawn a lot of scrutiny. I would imagine that it continues to do so.
Kevin Shirley, thank you so much. A busy day for you, a busy 2 days. Look for Sound on Bloomberg Radio. Really an extraordinary set of interviews recently. That is nationwide with Kevin Shirley. John, we go on to the inauguration, and I just can say, John, it's been an immovable feast day by day, and I must say it is completely swamped this morning by anticipated pardons.
An original moment for the United States of America, a divisive couple of weeks, Tom, for the United States of America. And in many ways, Tom, this year hasn't really gotten started at all, has it? 2021 just has not started in the way people hoped it would.
No, it hasn't at all as well. I'm looking at Goldman earnings, I believe, just out, John. Let's go over to that very quickly. Lisa, what do you see?
Well, Goldman Sachs' fourth quarter equity sales and trading, just to give you a sense of how much they beat, came in with a revenue of $2.39 billion versus an expectation of $1.96 billion in terms of expectations. We're also getting some other data. Their FICC revenue comes in at $1.88 billion. We'll parse through the numbers, but really people looking to the trading arm, since Goldman Sachs has traditionally been very strong there, to see whether they miss in terms of Bank of America or whether they continue with the JP Morgan trend in solidifying their dominance, Tom.
Oh, absolutely. John, what do you see on Goldman Sachs? I mean, it's a little different than Bank of America, to say the least.
Well, I think for the banks in general, Tom, let's just summarize it with a quote that came from the CFO of Bank of America about 30 minutes ago. We ended the year stronger than before the health crisis. That was the financial sector, ending the year stronger than before the health crisis. If I told you that back in March, spring of last year, Tom, you'd have struggled to get your head around that.
Yeah, absolutely. Let's do this. I went to one number, and I only did this because of Shonali Bassick. I went to the efficiency ratio. And, folks, this isn't apples and oranges. This is apples and, you know, that great craft beer that John drinks in the United Kingdom. It's not comparable. But Shonali Bassick, I've got an immediate efficiency ratio of 50.3%. That's a whole better number than what we saw from Bank of America, isn't it?
We'll take it. We like it, Tom. They are beating on some fronts. We have their advisory revenue. Goldman doing what Goldman Sachs does, advising on mergers and acquisitions, coming in way above expectations. But we have their fixed income trading coming in light. Now we have 3 banks that are light of fixed income expectations. What is that all about is going to be a question here. We also have ROE that's quite high, above 10%. It's not as high as last quarter. We're getting an update on Goldman Sachs' strategic plan. Remember, they had their first investor day ever last year on how fast they can bring up these returns, how fast, as we're seeing pretty fast right here, they can bring down their costs.
Shonali, we found out how well these banks, these names, including Goldman, can do in a pandemic. We need to find out how they'll operate in normal times, the return of normal times. What's your take on that at the moment?
So right now, as long as the economy stays in good shape, that is good news for not only the consumer banks, but also the Wall Street banks. Of course, you have this exuberance in the equity underwriting markets. You're seeing that in Goldman's results as well, as they beat on equity underwriting, and their debt underwriting is still quite strong. John, a lever here. Corporations have raised a lot of cash already. We need to see acquisition financing to keep that ball going forward this year. there. Goldman also, I've got to say, bought in more than $1.5 billion in consumer revenue. So the stronger the consumer is, you're even seeing the strength here go through Goldman Sachs.
That's actually exactly where I wanted to go, Shonali, their effort to push into consumer lending. Can you give us a sense of what you're looking for on the earnings call and as you parse through these numbers in terms of how much that business has expanded and how successful it's been?
Yeah, it's definitely something that, Goldman doesn't, and nobody expects Goldman to be Bank of America tomorrow, but it could bring down their cost of funding, and it could also help them compete. You heard JP Morgan just last week say they are keeping an eye on Goldman and they're pushing to cards. So any color they can give us on their card business will be of value. They're also launching an investing product, more retail investing product. They have restructured their management at all their major divisions, so we're going to want updates on how well they are doing.
The efficiency ratio all in later down in the PowerPoint is 65%, again, better than Bank of America. That includes some litigation affairs, a challenging 2020 on the litigation front. Dovetail this with your conversation from their fearless leader a number of days ago. How do you move Solomon into 2021 with these results?
Let me give you an interesting statistic about Goldman Sachs' investment bank. About a third of their business in merger advice comes from their middle market business. When we spoke to David Solomon a week ago, it was on Capitol Hill, or 2 weeks ago now, was on Capitol Hill for support for small businesses. What happens on Main Street absolutely matters to Wall Street, including Goldman Sachs, who you wouldn't consider a Main Street business at this point by any means.
Shonali, thank you. Goldman this morning with a decent beat. The stock up by about 1%, up 0.9% in pre-market trading. Joining us now is Christian Ballou of Autonomous Research, senior analyst. Christian, great to catch up. Just run me through your first take, please.
Yeah, it's a good morning, guys. Thanks for having me on. Look, it's a pretty strong set of results. At this point, we're really accustomed to Goldman generally doing quite well relative to expectations, and they did it again. Really strong numbers in equities, investment banking, and also on the efficiency front. So I think all in, a really strong set of results this morning.
When it comes to Goldman Sachs, people talk about strategy. Yes, they did beat on trading overall. That was driven by equities. They had a miss in debt trading. What are you looking for in terms of how they're guiding their strategy going forward as they try to shift from just an investment banking-centric place to something that includes more lending?
Yeah, so I think you have to understand the strategy in the broader context. They've been growing the banking business, if you like, the traditional banking business for quite a while. It's almost a decade now. And you've seen really strong growth in the net interest income and in the loan book. But I think as we go forward, that will play an increasingly important part in the story in terms of building out far more predictable revenue sources. So lending will be one, but the asset management business, the private wealth business, the alternative asset management business, and even in the traditional core investment banking, M&A, ECM and DCM type businesses. I think these are the businesses they have to grow. They are focused on growing and will ultimately drive the valuation of the company going forward.
Christian, in your research note, you always do a great job of you compare it. You even put a slash mark in it, the GSMS Combine. I'm fascinated by what you think. We see Frazier at Citigroup trying to do a Gorman and increase wealth management. We've got others as well. What is the pixie dust that James Gorman has in wealth management that everybody else, in asset management, that everybody else wants to copy?
Yeah, no, it's a great point. Look, I think James Gorman has done an absolutely unbelievable job at Morgan Stanley. You know this one, Tom, because you've been here for a long time. And, Morgan Stanley was more or less the basket case a decade ago. And they've turned out really to be, I think, almost a poster child of how you do a corporate restructuring. Look, I think they've really done a good job in focusing the wealth management business around efficiency over the last decade and lending, which has boosted pre-tax margins, almost doubled pre-tax margins since they acquired Smith Barney from Citi. I think going forward, the key for that business will be growth. Growth has been somewhat slower, as you see the migration of advisors away from the wirehouses to the likes of a Schwab and the regional brokers like a Raymond James. I think going forward for Morgan Stanley, a key part of their growth has to be pivoting that wealth business to growth. And I think the E-Trade acquisition and ultimately Eaton Vance will be very helpful in achieving that.
If you're just joining us on Bloomberg Radio, Bloomberg Television, worldwide, Christian Ballou with this autonomous research after years with Bernstein and Credit Suisse as we look at the state of global Wall Street. Christian, we've seen enough come in. I love your broker-centric view, but we've seen enough coming in from these banks. How do they prosper 5 years out? Everybody can't win at the same thing. So what is the sense of prosperity you see for major bank American Wall Street?
Yeah, look, it's a good question. Ultimately, I think the health of banks will depend on the health of economies over time. So I do think economic prospects are a really big driver of bank outlook. But also the reality is today is there's a lot of innovation out there, and some of the smaller fintechs have a lot of capital, and the market is willing to give them even more capital to go innovate. So I think your ability to invest in technology, your ability to be nimble around how you service customer, focus on customer service, that's going to be very, very important going forward. But ultimately, the banking business is really about economic prospects and sort of responsible lending. So those two will probably play a bigger part of
John, time. This whole digital thing underscored by the 8,000 shares of a firm you got on your sabbatical. I mean, John, to me, the great January issue of 2021 is the /fintech digital banking thing and how all these companies adapt to it.
Yeah, I'm doing so well, Tom. I considered not coming back, and that's why I've had the last 4 weeks off, just enjoying myself on those mega gains in fintech.
Mega gains.
Christian, build on that for us, seriously.
Bitcoin.
The conversation going forward and how much some of these names have got to spend.
Yeah, look, the dollars you spend is one thing. How you spend it is another, right? Clearly, if it was just about dollars, the biggest and best, or the biggest banks would stream away. So how you spend it, what you spend it on, your technology stack, all these things matter. But look, make no mistake about it. Banks have a lot of competition on their hand with some of these very nimble and forward-thinking fintechs, and it's no surprise that you hear a lot of the banks focus a lot on sort of the tech spending need to put in place to be able to compete.
Christian, we're getting bank earnings on a changing of the guard kind of day. We're going to get the last day of President Trump's presidency. And we have Janet Yellen testifying to the Senate Banking Committee, the Finance Committee, to talk about her nomination as Treasury Secretary. She has in the past expressed some desire to regulate banks. This will be something that will fall under her purview. What are you looking for to hear from her today in terms of how she will approach the banking sector in her tenure if she is confirmed?
Yeah, no, look, it's a good question. Look, I think the broader picture around the regulatory and political climate around banks, I think, is important context. I think coming into this crisis, for the most part, banks have been part of the solution, quite frankly, and not the problem. You saw from the latest capital sort of CCAR results that banks were able to get back to returning capital, and it speaks to really the strength of their capital bases. And quite frankly, I think regulators should pat themselves on the back. They did a very good job post the financial crisis to shore up banks' capital, improve their risk management, and I think it showed very well in the COVID crisis how resilient these banks are. And I think that's the broader context in terms of how not just Yellen, but I think how generally the political climate will deal with banks. They've been more of the solution than part of the problem, and for the most part, you do need a strong bank to sustain recoveries.
Christian, thank you. Always great to catch up, sir. Come back soon. Christian Ballou there of Autonomous Research. Goldman this morning up by about 2% in early trading, a couple of hours out from an opening bell, with equity futures up by around about 0.7%. Tom, the key call for me at the moment, looking at some of these banks, and it's a question perhaps more pertinent to the names like JP Morgan and Bank of America. Are we seeing just a massive reserve build last year turning into a reserve release, which transformed into a big buyback program? Or are we starting to hear some calls that go beyond just the next 6 to 9 months, a cycle call? And when you bring up 5 years, I think that is absolutely vital. what's the story for the next 5 years for these banks? What's the environment? What does the bond market look like? What do interest rates look like? And can we actually have a durable rally in these names on Wall Street,
right,
not just the squeeze we've seen over the last 6 months?
Well, those are the two themes that we've seen. I would point out someone trading it more like Douglas Cass down at Seabreeze says enough. I mean, they've really moved far and fast. We've got a great T-Live chart on that now with the excellence of Goldman Sachs through 2020. But, John, to your point, and I go back to, and I'm using this almost in a 19th century sense, the overwhelming technology that's out there. I'm going to go back to that statistic, John, I mentioned with Shanali, and that is Zells at Bank of America, where you take your phone and send John Farrow money because you lost a bet on Tottenham and the Tots. When you Zell John money because you lost a bet on the Tots, that's changing the landscape, John.
I can tell you I get a lot more money over my Venmo account from Tom than I
don't even know what Venmo is, and that's a point, John, that's a really important point. I don't even know what Venmo is, and you're right, Venmo and Zelle and the rest, they're changing the landscape.
We'll educate you as the weeks progress.
Please.
I'm happy to be back just to take that role, Tom, just to teach you a little bit, day by day. In the bond market this morning, yields are higher, the curve is steeper, ahead of a hearing with Janet Yellen down in Washington, D.C. Joining us now is Bloomberg's Michael McKee. Mike, how different will this Janet Yellen be than the one we all know well over the last few years, the last few decades?
Well, she is going to be different because this is going to be a political job. It's going to be a sales job. Her hearing today is not really in doubt. It's a question of when she's confirmed, not if. She's been confirmed 4 times before by the U.S. Senate. So she's well known. This is the first opportunity, though, to sell the Biden economic plan to the people who are going to have to vote on it. And even some Democrats don't agree with all of the provisions. So we'll see what she really emphasizes here. Obviously, she's going to say the economy needs it. And borrowing costs, despite what you said about bond yields ticking up a little bit, borrowing costs are so low, we can afford it. And that'll be her message today. It'll almost be as interesting, John, to see how the members of the Senate react as it will be to listen to her.
Yeah, in order to see who and how they're lining up behind this $1.9 trillion plan. Mike, how closely are you looking at Janet Yellen's comments on taxation, the idea of trying to pay for the increasing debt load that the U.S. is incurring?
Well, it's going to be interesting to see how far she goes with that. Obviously, the Biden plan over the longer term includes tax increases on the rich and on corporations in order to try to pay for some of this. But that's a little bit at odds with the Biden view that we need to go big right now and not worry about the costs. So it'll be interesting to see how she balances those two things out. Obviously, Republicans won't like the tax aspect and might hammer her on that. Democrats are going to like the stimulus aspect. We'll see where she comes down in terms of how she emphasizes each part of this plan.
Michael McKee, summarize the labor economy that greets Secretary Yellen. There was one statistic back in 1939. Heidi Shierholz at EPI was brilliant on calculating the claims, the unclaimed, and the rest of it. Give us the McKee treatment. How bad is the labor market?
Labor market's in pretty bad shape right now. It is bifurcated, however. If you're in the upper half of the labor market, if you're in the white-collar areas where you can work from home, you don't have a problem. Maybe it's a pain, but you don't have a problem keeping your job. But the people who have to go to work every day, particularly in the hospitality industries and transportation industries, they're suffering because business is really terrible, and it's going to be hard to get those people back to work. The word you're going to hear a lot from economists these days is scarring. People who are long-term unemployed without necessarily skills that translate into the jobs that are available. And that's going to be a tough thing. And that's why you'll see a second round of stimulus proposals from the Biden administration, an infrastructure program, loosely defined at this point, but a way to try to get people back to work, try to create jobs, because the economy itself is having trouble creating jobs on a sustaining basis.
Hey, Mike, great to catch up. Michael McKee here in New York City. And Tom, the debate really hasn't changed. It's that distinction between aid and stimulus. If you send everyone a check and the economy is still shut down, where do those checks go? Well, I can tell you for the people without a job, those checks will go to pay the bills. for people that still have a job, those checks will go straight into the bank account and go into the savings rate that we've seen flying over the last 12 months.
We've seen deposits at the banks go up as well. John, I've got to go back to an EPI chart that came out that models from 1963 the wage growth of the nation versus the minimum wage, and it is absolutely stunning, modeling out to $16.28 an hour. That has a huge amount to do with the tension that the president-elect will address tomorrow.
I have to say, it's going to be very interesting to see how Janet Yellen handles the politics of the minimum wage debate. From New York City, back in New York City, for our audience worldwide, live on Bloomberg TV and radio, alongside Lisa Abramowitz and Tom Keene, I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. Janet Yellen will have a different task than she's used to when she goes before a Senate committee today for a confirmation hearing. Joe Biden's pick for Treasury Secretary will defend the president-elect's $1.9 trillion stimulus package. Yellen is expected to tell them low borrowing costs mean it's time to act big. She's a former Fed chair who spent years defending central bank thinking and actions. And the Biden administration has rejected a move by President Trump to rescind travel bans on non-American citizens arriving from the EU, UK, and Brazil. The bans are aimed at preventing the spread of coronavirus. President Trump said the bans could be eased safely, but Biden officials, however, say they plan to strengthen public health measures around international travel. And President Trump's approval rating has dropped to 34% in a new Gallup poll. That's a low point of a presidency that's already had the weakest average approval rating of any of his predecessors since the survey began in the 1940s. The president's approval rating has fallen 12 percentage points since before the election. In Italy, Prime Minister Giuseppe Conte faces a crucial test today. There's a confidence vote in the Senate one day after he won a similar vote in the lower house of Parliament. A narrow win in the Senate would allow Conte to stay in office, even if his support falls short of an outright majority. And Tesla has begun delivering the first Model Y SUVs built in China. It's the second locally built electric vehicle Tesla has sold there. Last year, the Tesla Model 3 was China's most popular electric car. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The strategic plan that we set out in February last year really aimed to transform HSBC over the medium term by effectively shaping the organisation, investing in growth. The world has changed. Low rates are likely here to stay.
Mark Tucker, the chairman of HSBC. For our audience worldwide this morning, good morning from New York City alongside Tom Keene and Lisa Bravitz. I'm Jonathan Ferro, live on Bloomberg TV and radio. Here's the price action this Tuesday morning as Wall Street gets back to work after a long weekend. We add some weight to the S&P 500, up around about 0.7%. We advanced 27 points. On a bond market, the yield on a 10-year higher, the curve steeper, up 3 basis points on 10s to 1.11%, on 30s up 3 to 1.86%. Tom, low rates are likely here to stay. That for me is one of the key differences between now and the early part of the recovery around about 10 years ago. 10 years ago, many people projected out higher rates at central banks, higher yields on treasury curves. This time around, completely different. The consensus has capitulated on the idea that rates have to go higher. Rates for many people are low, and low for a whole lot longer.
Well, that's clearly the consensus feel. I mean, there's a whole school of thought out there that this time we go. But I would say in the last week or so, John, that clearly ebbed away. Someone good on this is David Page. He's at AXA Investment Managers. And what he does, and this is really, really difficult to do, he focuses on the UK economy and the US economy at the same time. It sounds like something that would be easy to do, but it takes a real skill. Mr. Page can do that because he got better grades at work than John Farrow. We're thrilled that he could join us this morning. David, how do you color austerity? That's our question of the morning, whether it's almost a Calvinistic austerity of the United States of America or a tangible austerity of your United Kingdom. What does austerity in 2022 look like to you?
Well, we think it looks slow. I mean, I think you're right to say 2022 is where you'd start to see it come through. I mean, there is always the trap at this situation. You see deficits rising, and the natural reaction is to try and stop spending. And that's the surefirest way to see the medium-term debt actually higher than it would otherwise be. So I think that what treasuries across the globe have to do is lean into this. They have to continue to provide that fiscal stimulus. They have to try and get the fast rebounds that the economies can achieve if they're supported. And with those fast rebounds, your debt to GDP starts to fall back over the medium term. But we've seen it time and time again, and we saw it, just recently, within the last 10 years. We saw a very swift return to austerity in Europe, to some extent in the US as well in 2011. And the recoveries were lackluster on the back of it. So I think this time around we're seeing, particularly in the US, but I think most likely across Europe as well, and in the UK, more acceptance that stimulus needs to keep coming, and that fiscal stimulus perhaps removes over the longer term some of the...
Well, this is sort of the interesting question.
Yes, I can. Yeah, can you not hear me?
We're working on the audio with David. But John, just come on in here, because one thing that's really interesting to me is something you've talked about so much, this idea of all the fiscal hawks have died, right? This idea that who's a fiscal hawk in this world where debt doesn't seem to matter. And the real question that we're going to be talking about is, when does debt matter? Does the load matter, or is it really just about juicing growth at all costs, John?
Well, let's start with the fiscal hawks. Let's start there. In the UK, quite clearly, there is an audience that some politicians in the UK government want to play to. This idea that, yes, at some point we'll deal with this, at some point we'll have to raise tax and taxes. And Lisa, for me, I think it's a policy mistake to even allow the conversation to leak onto the front page of the newspaper. What do you want at this stage of the cycle? You want people to believe that rates are going to stay low. You want people to believe that taxes aren't going to go up. Why do you want that? Because you want people to engage in the economy. You want businesses to spend, not just sit on their hands. Now, if you're a business and you're looking out a year, 2, 3, 4, 5 years, and the government is telling you that at some point they're going to have to raise corporate taxes, and they allow that to leak onto the front page of a newspaper in January 2021. Lisa, I have to say, I think that's a massive mistake. I think it's foolish. I understand why you want to play to a political audience, but now is not the time to do that. And I actually think the way that Janet Yellen constructed her argument in this testimony to say, we recognise the issues with the debt, but right now, it works to act big with rates where they are. And the UK, look at the gilt curve. What's the UK's excuse?
Right.
They haven't got one.
Well, and that seems to be the predominant argument among economists, that right now, debt does not matter. Juicing growth is the preeminent concern. But David, come on back in here. This question of taxation, do you agree with John that any discussion of it is a mistake and that, frankly, we don't even have to think about it? Or is taxation at some point going to be necessary and won't necessarily hamper growth as much as people expect?
I think it's a mistake to consider it at this stage. And I think it's a mistake that's often politically driven. So there are those that sort of think about the government like a household. You know, if a household sees its income fall, then it does have to cut its spending. Governments don't work in the same way. Now, that's not to say there shouldn't be a long-term commitment to sound public finances. That's absolutely paramount. But the long-term commitment to sound public finances doesn't necessarily mean that you have to do tax increases or spending cuts in the very short term. So over the period, what you would expect is to see a period probably for a year or two where fiscal stimulus is basically deficit financed. You would then probably see some sort of balanced budget where you start to see some increases in taxation come through, but you recycle it into higher spending areas of the economy. And then later in the cycle, that's when you can start considering maybe some spending cuts coming back. But the multiplier likely varies across the course of the cycle, and therefore government spending should adjust across the course of the cycle as well.
David, 10 years ago, the policies enacted on both sides of the Atlantic really laid the foundations for what the cycle would look like, and Europe underperformed massively. Are you starting to see the same thing happen again?
Well, I think if President Biden is able to pass through anything like the spending programs that he suggests, both in terms of the shorter-term 1.9 billion proposal that's currently on the table, but also, you know, in some form of longer-term spending bill that tries to embody some of his manifesto, then I think, you know, the outlook for fiscal stimulus in the US will be markedly ahead of what it is in Europe, or certainly what's planned in Europe at the moment. And therefore, yeah, I think there is a significant chance of US significant outperformance against a euro backdrop, which slowly rolls out a more modest form of fiscal stimulus. But, you know, basically leaves the ECB having to do a lot more for a lot longer.
David Page of AXA. David, great to catch up, sir. Thank you. Tom, this is one of the key debates developing already this early on in the year, the recovery and the rest of the cycle, and the ability of Europe to keep up with the United States. And given what we've seen and what we're hearing already on the vaccine front, on the fiscal front, on other issues as well, those calls are coming through for the United States, not for Europe.
Well, yeah, not for Europe, definitely, but I would look at a commodity boom right now, and particularly, John, in Australia and how that works. And we thank Bushan for listening, watching us as well. On cricket, John, rain at Brisbane, Australia, way behind India.
Cricket. Tom Keane, I've missed you, Tom. I've really missed you.
Thank you,
our audience
Bushan,
worldwide from New York City. This
They need 98
Bloomberg.
overs.
直播。我是郑志勇，可能大家更知道我的网名叫做望京博格。我开始做直播是在今年年初的时候，就主要是去年的话，参加更多的是线下的活动。今年大家都知道，由于中国的这个疫情，导致这些线下活动不能办了，所以更多的交流方式在线上。就今年春节之后，主要是开始在线上通过直播的方式跟粉丝进行交流。直播可能对于投资者来说是陪伴投资者，大家讲讲市场啊，讲讲投资的心理啊，这样的话就可以让大家在投资的时候，心情更平缓。平缓的话能做到长期持有，长期持有的话才可能赚钱。相对而言，线上可能覆盖的人群更多，因为可能疫情很多人在家里看直播的人更多。反而可能我这个工作可能是反而是受益于疫情的一个工作吧。
明天希望高开赚钱，
祝大家赚大钱。
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's not bad news is good news anymore. It's bad news reflecting really painful couple months ahead for the economy.
Political risk is a persistent theme here into 2021.
You have all of the telltale signs of a structural bull market at play here.
The stimulus is coming. That's going to help the consumer and small business.
I don't think we should be fearing that inflation is going to be running off to the races.
There's a lot of monetary stimulus coming in. There's a lot of fiscal stimulus coming in, and there's recovery from COVID. It's kind of like a 2009 year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance on radio, on television as well. An inauguration tomorrow. It is Pardon Tuesday, widely presumed from the White House and from President Trump. We join you on our simulcast to speak of economics, finance, and investment. We'll get to the investment side of it here in a moment. But, Lisa, we must make note that finally, after a world sojourn, you know, it was like out of the 19th century and Lord Byron, he is back. And John, you and I talked this weekend as you were getting off the Gulf Stream, and you talked about what you observed on your travels of people lined up to get back into America. Talk about that.
Yeah, it's not a secret that I've had some visa issues over the last several months, and I won't go into too much detail about them, Tom. But whilst this country was drowning in divisive politics and the ugly scenes of the last couple of weeks and talking about the decay of the United States of America, I can tell you that I was outside a US embassy in a line 100 people deep going around the corner, and the sun wasn't even up. And in that line, Tom, were just a whole group of people from all walks of life looking forward to getting a working visa and getting back to the United States of America. And without laying it on too thick this morning, Tom, I think it's important to recognize that as we work through some difficult times in America, it is still a country that offers millions of people the world over a whole lot of hope and promise.
We'll see. Lisa, you know, so much going on here, the emotion that Mr. Farrow has missed on his travels. Your thoughts, Lisa, on this final active day of a Trump administration?
Yeah, well, we're going to be seeing whether the pardons come through and what they are. But to John's point about people coming into the country and immigrating, that's going to be one of the key questions for Joe Biden as he comes in, how he's going to change some of the immigration policies and other. And this, frankly, dovetails very much into the economy because the population growth has slowed tremendously in the United States. And we're looking at debt to GDP right now heading toward 200% by the year 2050. It's okay if yields remain low. What happens if they don't? How are we going to pay for this with a slowing population and rising obligations?
Any of you that know my work here over the years, what Lisa nailed there is the idea of demographic growth, and so much of that comes from immigration. Of course, front and center is the #1 theme, the divisive theme of this nation. Let me look at the data right now. John, help me out. You're so rusty on this. We got to get you back in the game. Futures up 27. Dow futures up 208, 30,928. Nice. The yield, 10-year yield, 1.11%. John, what do you see when you consider the real yield?
Every time I tuned in over the last 4 weeks, I just heard you polluting the airwaves with Dow points and the Dow. I'm happy to be back to try and clean this up a little bit. Tom, I'm looking at a steeper curve. I'm looking at high yields. I think the demographics point is really important because this is about the outlook for an economy that goes beyond just the next 6 months. Beyond the next 6 months where you get that mechanical reopening, you get the vaccinations, you get people re-engaging in the economy the way they couldn't 12 months ago. You get the extra stimulus checks, you get people going out there and spending. Tom, how long will that last? What does that look like in 12 months' time, 18 months' time? Can we really alter the trajectory of the US economy and lower trend growth? The lower trend growth we've experienced, by the way, over the last 10 years or so. That's the effort I think we need to focus on down in Washington, D.C. I don't think a one-off check changes that. I think you need something else.
A one-off check won't do it for Brent Schutte. He's with Northwestern Mutual, and of course, they're looking at actuarial assumptions. They're looking at long-term investment as he provides investment guidance as their chief investment strategist. Brent, what is your line right now on investing for 5 years? I don't care about the here and now. I care about a more long-term Northwestern view. Is it a single-digit return, or can we do better?
Yeah, I think it's a single-digit return, but you mentioned something real important because I think people get caught up in nominal returns. It's only real returns that matter, and so within that real return being in the single digits is assumed to be in a lower inflation rate. Now, if inflation is higher, certainly there is a revisiting of those estimates that you have, but in general, I think people should just focus on real returns, and if returns are in the single digits, it is likely that inflation will be low, and so all in all, consumers and citizens will still be fine.
Brent, you know what I find amazing looking at markets right now and just going through a long list of research notes that reflect on valuations and say you can only really develop an argument on valuations by looking at where valuations are relative to interest rates. And returns, therefore, are going to be great for the next several years because rates are going to stay so low. My difficulty with that, Brent, is that we've all seen the last 10 years in Europe, in Japan, where rates have been ultra low for a very long time, and markets just have not returned big gains over the last several years in Europe. Low rates don't always get it done, Brent. Why is the United States any different?
I just think because of the monetary policy that we've had and the promising to do more, and the fact that our long-term growth rate is above those places that you mentioned because of demographics, because of productivity. And so there is a little bit better of an outlook here in the U.S. based upon that. And I think one of the commentaries that you guys kind of missed in the beginning is that productivity is actually rising in the U.S. And so perhaps our long-term growth rate is inching up if you think about productivity finally coming back after being dormant for some time with the technology boom that we've had in the U.S. And so I would focus more on that. And I think you're 100% correct. I mean, the risk to me is still, and this probably combines into your earlier talk about there being no fiscal hawks. I mean, to me right now, the central banks around the globe, especially in the U.S., are going to do more until one of three things happens. Either the dollar falls too much, inflation rises too high, or perhaps people start demanding a real return on their fixed income because the stock market is built on the bond market. And so until those three things occur, and actually two of the three are considered positive right now, until they occur, then I think we continually have the market moving higher because right now the cost for policymakers on the other side is zero. There's nothing for them to contemplate. They're actually trying to get a couple of those things to happen. And so until that changes, until this debt comes due, I think the market moves higher.
All right. So, Brent, implicit in John's question, and it's an important one, is this idea that perhaps there is a fundamental inconsistency between rates remaining so low and growth being sufficient to justify equity valuations where they are. At what point does one of them have to give? Do we have to either get higher rates on the heels of more inflation, or stock valuations have to go down because people have been pricing in just too much growth?
I think it's probably a combination of both, right? So if people lose hope in the future, then certainly I think, or our growth rate dramatically slows, then I think the first part that you mentioned is certainly true. And so the other side, which I still think is the bigger risk, is that rates do rise, and you actually have the stock market having to reprice because now bonds are more attractive. Because I do view valuation, and this is where I think people miss the boat. Valuation to me is a relative tool, not an absolute tool. Money has to go somewhere. When our advisors sit down with clients, they decide stocks or bonds, not neither of each.
This is so important, folks. Brent, it's right where I wanted to go, which is the idea of absolute and relative. The NASDAQ 100 12 months trailing, TMT, is up 40%. The Russell 2000 out of nowhere is up 24% as well. I mean, two polarities, if you will, in terms of factor analysis and such. Do you sell those to get an absolute return on the other stuff, or do you do it on a relative basis and use new cash to go someplace else?
Well, for the past 6 to 9 months, I've been coming on this show and others and talking about moving into cyclical assets, moving into small caps, things that are more leveraged to global growth or even just broadening U.S. growth. And so if I take you back to 2018, a lot of these charts went completely off the rails. So tech started outperforming everything else. Growth did better than value. Small cap dramatically underperformed large cap. And if you think back then, we were first introduced to the trade war, which was designed to knock out levers of growth around the globe. And it had a pullback in the U.S. also. It knocked our cyclical side out. The U.S. pushed higher because we do have that big tech sector, especially in large cap stocks. And now you are starting to see the economy broaden back out even before COVID hopefully releases its grip. You're seeing manufacturing do well. We think that continues into 2021, and that broader inclusive growth means that the stock market will be broader and more inclusive. And so it is branching out into things like value. It is branching out into things like small caps, even emerging markets. And we think that continues into 2021.
Brent, can I ask you a philosophical question just to wrap things up? We've heard so many times on programs like this, people lining up to say they think we're in a bubble. By definition, can we be in a bubble if the majority of people that come on programs like this think valuations are close to bubble territory?
Look, I think there are parts of the market that are expensive that are built upon dreams that may not come to fruition. I think there's a whole lot of parts of the market that will do well in the coming environment. And if I take you back to 1999, yes, there were parts of the market then that were expensive and people talked about a lost decade, but the decade was really only lost in those expensive parts of the market. Things that hadn't done so well into 1999, like small caps, like value stocks, actually did well up until 2007 when the world fell apart at the seams. But they actually had a good run during the 2000s, and I suspect this time will be very similar. Things other than the things that have done well because of the narrowness of the market will actually perform into the future. And I guess that's the good news about diversification, is that you will have parts of your portfolio that will pull along the rest of the parts that may underperform. And I think they've kind of switched from what they were to what they will be.
Brent Schutte of Northwestern. Brent, great to catch up, sir. Thank you. Lisa, I asked that question just for you.
Thank you.
Obviously.
I appreciate that.
In bubble calls.
Well, and I think that the real question is, how much can we see some of these bubbles that people are expecting to pop at some point? Bitcoin, as some people are saying. I couldn't help but mention that. How much can you see that and not see a disruption in the rest of markets, John? And this comes, frankly, I will say Bank of America surveys just show that people think that Bitcoin is the most overcrowded trade right now.
With tech and the short dollar call in the mix as well. Alongside Lisa Bravitz and Tom Keene this morning. Good morning. I'm Jonathan Ferro, back in New York City for our audience worldwide. Heard on Bloomberg Radio, seen on Bloomberg TV, with equities up 0.7%. The beauty of working remotely is that I can sit back and just pretend I can't hear him. It's the delay.
When is high tide?
The sound's not good enough. I can't hear him. I can't hear him. Turning the volume down a little bit more. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. Treasury Secretary nominee Janet Yellen is expected to tell a Senate committee that low interest rates mean it's time to act big on a coronavirus stimulus package. The former Fed chair begins her confirmation hearings today. It will be the first time lawmakers can question someone about the Biden administration's $1.9 trillion relief plan. Meanwhile, Joe Biden reportedly will propose a comprehensive immigration bill on the first day of his administration. According to the Associated Press, it will include an 8-year path to citizenship for roughly 11 million people here without legal status. That's a massive reversal from Trump administration policies. And White House officials don't expect President Trump to pardon himself, his family, or close aides. Still, the president is expected to announce a list of pardons today that may include one for a famous rapper. The performer known as Lil Wayne pleaded guilty to a federal gun charge. It's not known who else is likely to receive a pardon. And the International Energy Agency has lowered forecasts for global oil demand. It's cut its first quarter estimate by 600,000 barrels a day. The IEA says that the global vaccine rollout is putting fundamentals on a stronger trajectory for the year. Still, forecasters say it will take more time for oil demand to recover because of new lockdowns. In Europe, car sales fell the most on record last year. New vehicle registrations plunged 24%. Relatively resilient demand in the second half of 2020 only did so much to make up for the collapse during the initial coronavirus outbreak. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. Much more to come. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It's pretty clear that the U.S.-China debacle is here to stay, potentially without some of the kind of knee-jerk reactions like the Trump administration have put forth. But I think you're going to see a lot more dialogue in the coming year with the new administration coming in.
An important conversation with a gentleman from Oliver Wyman. Mr. Tannenbaum is better than good on sanctions and on the punishment that they can cause. And, of course, these are tangible issues with China. Jonathan Farrow, Lisa Bramwitz, and Tom Keene, we welcome all of you on Bloomberg Radio, on Bloomberg Television. And this is, without question, my China conversation of the day. Leland Miller is different. Besides being exceptionally competent on Asia and on China, for years, he's taken a different tack of looking at China data. No one I know digs deeper on China than Mr. Miller. He joins us right now. Leland, your note is very strong. You speak of deceptive data out of China. What is deceptive?
Well, I think if you focus only on headline growth numbers, you're going to get a very cheery story coming out of China right now because their recovery is better than any other major economy in the world. But the true question for markets should not be whether China can nail a certain GDP number in a particular quarter or year. It should be how healthy is the growth? What is the composition of the growth? Is it sustainable going forward? And when you look at the consumption economy, it's by far the weakest part of this recovery. And you see it in the retail data, you see it in the services data, and it's the real question mark looking forward, both in our data and in government data.
You and I have talked for years about this, about deceptive data in China. Do you look at the vector of which way they're moving, or is it so messed up now, even the vector, the trend is deceptive?
Well, you know, it's funny because during this recovery from a COVID virtual standstill last winter, we have seen very much the same thing as official data. We just haven't seen as intense a recovery. So we saw the beginning of the recovery. It was manufacturer-driven, and then it was property-driven. Basically, the industrial economy, the supply elements of the economy driving China back to growth, but lagging behind consumption. Households are much more tame in their behavior. Retail, services, again, those parts of the economy have not bounced back as much. So it's not that we're seeing a different picture. Sometimes we do. Sometimes we're totally diametric to what the government's reporting. Right now, we're seeing a similar picture. We're just not seeing the intensity of the recovery that Beijing is claiming.
So, Leland, can you put this in the context of the U.S. GDP? Because a lot of people have said that the faster than expected growth in China puts it on track to exceed the U.S. economy much sooner. Do you think that that's been overstated based on what you're seeing on the ground?
Yeah, I know people care about this, but the question, I think, is not what we should be focusing on. If China wants to beat the U.S. in GDP, it could simply by building an endless bridge from Beijing to California. The bridge would fall in the water, but along the way, you get enough aggregate growth, not productive growth, but aggregate growth to ramp up GDP levels in the stratosphere. When you're looking at this, much more important would be GDP per capita. I think the U.S. GDP per capita is 6 times or so greater than China. Household income, household wealth is more important. These are the things that make a country great, and it's I think a complete distraction to be looking just at the GDP number, which can be manufactured in the short term, but lead to serious long-term problems if you do that.
Perhaps, Leland, at the same time, you see an increasing amount of foreign investment into China. People saying that the government will support the economy, that will support asset prices going forward, and will continue to do so as they try to give the appearance, at least, of faster than expected growth. Are you making an argument against those investments, or perhaps against some of the enthusiasm that we're seeing, somewhat unbridled, from across the world?
Not really, because look, if you're investing in China right now, you're doing it probably for 2 major reasons. The first is diversification purposes. You want to put more money into a growing economy. The second thing is you look around the world and a lot of things look really bad right now. China's had the top COVID recovery, and so there's a lot of reason to put more money into China with all the opportunities there. I think where people fall short in their analysis is they look at China and they say, wow, there's this growth story. You've got 1.3 billion consumers. They must be buying a lot of things. There's going to be this linear growth pattern. Let's just go in blind. And you know, you can see right now in the consumption data, there's a lot of problems with what's happening in China right now. It just happens to look a lot better than a lot of other places.
Leland, the other issue that we've seen this year has been the divergence in exports and imports. And we've seen a real increase in exports from China to the U.S. and around the world. Do you expect the stronger yuan to really hamper that? I mean, how much do you expect that to become a headwind for the nation?
I think Beijing's in a bit of a pickle. They've allowed the renminbi to appreciate this year because they don't have much of a choice with the trade surplus hitting record highs recently, but they don't want to see a skyrocketing yuan. What they want to do is they want to keep it relatively stable with a slight appreciation towards strength against the U.S. dollar. So I think what they'd like is just this beautiful stability. But because China's a more attractive destination right now, because of the COVID recovery being so well done, you've got these real pressures. So they're not in a danger area right now. But I guarantee you, it's causing a lot of sleepless nights thinking where this could go if the U.S. keeps going in the other direction, and they're forced to keep making this currency go up or face the political problems with not doing that.
Beautiful stability. That's what we all want. Leland, great to catch up. Leland Miller there of the China Beige Book, almost 12 months on from cities across China shutting down. And Tom, I have to say, 12 months on from Davos, Switzerland and the World Economic Forum, and sitting there with a bunch of CEOs singing Kumbaya about a whole range of issues that had nothing to do with COVID-19. 12 months ago, wow, did the world miss what was about to happen?
Yeah, John, it's amazing the stark adjustment. And of course, it was a natural disaster, a pandemic that nobody saw coming. While you were on your sabbatical, John, Richard Edelman stopped by with a blistering trust barometer. Really, folks, the hallmark every year to the start of Davos, not this year in January. Pharaoh's suggesting he'll go from Key West to Singapore here for the real Davos later this year. But John, Richard Edelman made really clear it is a completely changed trust matrix right now, and he was heated that CEOs have to pick up the rhetoric to assist governments.
You know, for once, Tom, I've got no real defense on the sabbatical issue. Usually it's after I take a couple of days vacation, but I guess after a month, you've got license to take this a little bit further. Just tell me, just so I know, how long will you keep this up for, this sabbatical story? Are we going to do this for a week?
Lisa, help me here. I mean, I think we get out to where Tottenham slides back into first place, and that ain't happening.
When we start to get protests, when people start writing in saying, stop it already with the sabbatical talk, then we'll stop.
What's so sad, Lisa, is Pharaoh thought the damn show shut down because he wasn't here.
No, he was watching the down points. Are you kidding?
Lisa sent me a message every morning at about 7:04.
Yeah, like I did.
And the subject just read, please come back. Please come back.
Please,
that's what Lisa said to me every single morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro, ignoring Tom Keene through to the month of February at least, and maybe into March as well. I can tell you that S&P 500 futures are up 27.
Look at that.
We advanced 0.7% on the S&P 500. In the bond market, yields are higher. The curve is a little bit steeper. And the main event is down in Washington, D.C., when we hear from Janet Yellen, soon to be the Treasury Secretary of the United States of America. Heard on Bloomberg Radio, seen on Bloomberg TV. I'm pretty sure Janet Yellen does not follow the Dow. This is Bloomberg.
typical clothes wash, up to 700,000 fibres can come off our clothes.
Permet de collecter environ 3 à 5 tonnes de déchets de PET chaque mois. Donc, une partie est utilisée pour faire des bateaux, une autre partie pour faire d'autres poubelles, et d'autres parties, bouteilles, sont plutôt stockées que nous fournissons à certains partenaires.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Particularly, sort of the technology landscape, gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City, for our audience worldwide, good morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. As we count you down to testimony, a hearing with Janet Yellen, soon to be the Treasury Secretary of the United States of America. Let's check in on the price action as we add some weight to the S&P 500. Futures are higher, Treasuries are lower, yields are up, the curve is steeper. Equity futures up 0.7% on the S&P. We add some weight to the benchmark, up 26 points. What if I told you that we are just 22 points away from where we'll finish the year? That's the message coming from Citi, from SocGen, from Bank of America, from Stifel, who have a year-end call of 3,800. We're very close to it already. In the bond market for treasuries, the talk of more supply and what that supply will achieve is the story. Yields are up. The curve is steeper, up 2 basis points on 10s to 1.106%. That's the price action at the headline level. I understand this is the part of the program where Paul Romain Bostic gets dragged into work early and Tom Keene spends about 2 minutes just shouting at him. Romain, I'm so confused, Romain. Why have you tolerated this
I'm
for
confused
2 weeks?
Too, John. By the way,
and how long before
you've missed a lot in the 2 months that you've been gone. But let's take a look here at some of the individual movers on the day, John. Cisco Systems, a lot of action in the M&A space. Remember, Cisco had that deal for Acacia. The Chinese regulators basically slow-footed. That deal fell apart. Cisco came back to the table, 70% premium. Chinese regulators say now, we'll sign off on a few conditions there. Nevertheless, it looks like this deal is going to get done. Most of the gains in Cisco and Acacia were last week. Acacia was up about 40%. Lumentum also in the news. They're making a big deal here for Coherent. Keep in mind, these are basically two companies that make optical equipment. Lumentum in the computer space, Coherent basically in the medical space. So this is going to give Lumentum ability to spread its wing. And Citrix here, on the day, they're buying a closely held company called Reiki. It's a competitor to Slack. And remember when that Salesforce Slack deal went down back in December, a lot of people said, keep an eye on some of the competitors to Slack. They're basically M&A targets. Citrix Systems going to snap up one of them. We can also talk about earnings here. A lot of earnings already crossing the wire. I know you guys are talking a lot about what's been going on with the banks, Bank of America, Goldman Sachs, but you take a look at here, what's happening here. Western Union, actually, excuse me, that's not earnings. Western Union, up strong. Western Union, Tom, up strongly here. They're going to be, and get this, Tom, 4,700 Walmart stores. And I know you wouldn't be caught dead in a Walmart store, but a lot of people shop there. This is huge for Western Union. MoneyGram actually down because their presence there might get cut back. Halliburton now with some decent earnings here, saying that they've finally seen a bottom in the oil feed service. And you want Netflix on sale at 4 p.m. after the bell, Tom. on what is probably the most watched show on Bloomberg Television. Ooh. We're going to talk about Netflix earnings expected to surpass 200 million subscribers. But here's the deal, Tom. The expectations here are so high. Yeah. The shares have actually really been kind of strong. And think about this. Right now, you talk about a company that really had no competition for years. Now it's got Disney Plus, Apple Plus, Discovery Plus, Bloomberg Plus, a lot of other pluses out there that they're really competing in. And then for Farrell here, look, they're giving out deals right and left. They're going to have 70 new programs next year, original movies next year. Basically going to try to roll out one a week. They've given deals to Dwayne "The Rock" Johnson, Leonardo DiCaprio, and I hear they're even going to option a screenplay from John's travels around the world.
Yeah, real yields. It's very good. Yeah. I'm going to look at The Dig, which is, John, about when they dug up all those old gold things in the United Kingdom, the Sutton, who, they dug up the boat or whatever. I mean, this could go to the top of the Netflix charts.
I don't know what that
Nobody knows what he's talking about, I don't think.
Okay.
All right. Well, welcome back, John, and good morning to you, Tom.
John,
thanks for me.
Good morning to you.
I appreciate that.
Fine. Go back to your top-rated program. TV. Helping us now, we let an adult into the room. Allison Williams will join us, Bloomberg Intelligence here on the banks. Allison Williams, I want you to give our radio and TV audience a clinic right now on the efficiency ratio. Is Mr. Moynihan concerned about his sky-high efficiency ratio?
Well, I guess three key things there. One, there is a business mix differentiator, so they're only going to be able to get that so low. Two, the uptick in the second half in part relates to higher joint venture costs. So those, I guess, are the two caveats. But three, I think expenses are really the bigger story this quarter across all the financials, and not just the banks, but I'm even lumping BlackRock in there, and we'll hear from more asset managers next week. And it's not, I guess there's a couple things. First of all, you have lower revenue, you're going to have a higher cost ratio, but it's the investment spending. And so JP Morgan guiding costs higher on investment spending, Wells Fargo guiding costs higher on investment spending, BlackRock guiding higher on investment spending, not going to get operating leverage because they're spending on investments. And Citigroup, I guess you can call it investment spending. A lot of it relates to some of the regulatory issues, but getting their systems in place. Bank of America has already said they're spending more on technology next year. And so what we've seen at the U.S. banks, if you step back, the investment spending has paid off. They have gained market share, but they're going to be spending more to do it. So that's what we're going to be listening for on the call, which is starting about now.
Allison, investment spending is nothing more than the funding of the new digital banking system, right?
Well, to some extent, yes. A lot of it is technology spending. Bank of America, actually, their costs came in a little bit higher. They say it's due to marketing spending. I think sometimes investors can be skeptical because, the higher costs are a given, and it's harder to see exactly what the benefit is. And I think, with someone like BlackRock, I think the concern is, yes, we are seeing the benefit, but at some point, does it start to fall to the bottom line, or is this investment spending just a permanent part of your cost structure, a permanent higher cost to compete with all of these emerging fintechs?
And it's really, Tom is right to talk about the expense ratio, because people read this, and Allison, you're talking in all of these terms, but really it comes down to, when are they going to start laying people off?
So I think we already actually saw, for the industry, we have seen some pullbacks. We might see some this quarter. To your point, we might not see it at Bank of America because of some commitments they made. But I do think that is something that we are going to see. When we talk about efficiency, a lot of that is, a lot of the efficiency, for example, on the branch side, which has been a big story of Bank of America, is making those branches, more digital and less human intensive.
How much are the banks just really a subject to what happens with 10-year yields at this point?
I think for the stocks, obviously, there's a very high correlation with the 10-year, and that's been the case sort of since the last crisis. From an earnings standpoint, it is fundamentally true that a yield curve steepening is important, but you do have to look at why the 10-year is going up. And if it's going up because the economy is improving, that's obviously good for banks.
I look, Allison, at the summary of where we are, and I want you to go on. I want you to talk like Moynihan or Diamond, the rest of them, with a 5-year plan. Do these people have a 5-year plan anymore, or are they just giving that up to get to the next quarter?
I think that it is obviously a balance for every public company to focus on the 5-year plan, right? And that's why when we're talking about these investments, you know, you need to keep sort of your eye on the long term, even though we have things like the interest rate pressures. And the interest rate pressures are weighing more heavily on someone like Bank of America because they are more exposed to that. But you don't want to necessarily have them cutting back on sort of the infrastructure for long-term growth just to make any given quarter.
Allison, just sort of pushing ahead, we were expecting announcements of share buybacks. We have gotten them from a number of banks, including Bank of America this morning, with a $2.9 billion planned share buybacks. When do you expect big banks to be able to increase their dividends? The dividend caps get lifted as the pandemic subsides. Is there a time limit that's being priced into the shares at this point?
I don't think there's a time limit that's priced in, but I think in relation to, you know, we saw this quarter the reserve releases, so that's a sign that the economy is improving. But I think the Fed is going to want to make sure that we are really sort of in the all clear before they take off all of the limitations. And I think most expectations are that that's going to come within the next couple of quarters. And so I think if that doesn't happen, to your point, that there could be disappointment. We do have the next round of stress tests is in June, although I think some people think that we could get the caps lifted even before then.
Alison, just quickly, just to finish on that, on policy down in Washington, we'll hear from Janet Yellen later. It's going to be about fiscal stimulus. The main part of the conversation will be. But for you, as you look at bank regulation and the incoming administration, what are you expecting? What kind of changes should we be preparing for?
Nothing really in the near term, and you know, our regulatory analyst Nathan Dean has said, you know, that the critical thing to watch for banks, which is a long time from now, is, you know, if the Democrats really control for a second term. So, currently, there's obviously other priorities in place right now for Biden. Also, the slimmer majority in the Senate and House makes it less possible that we get anything meaningful in the near term. So perhaps we start to get some things introduced later in the administration, but we would really need a second term to get any sort of a big change. What would the changes be? The changes would probably relate to some of the capital regulation, and we actually saw JP Morgan come out on Friday with some arguments that they're making in terms of how the regulations could at the end of the day, you know, increase their costs, which they would pass on the consumer. So sort of a little bit of a proactive argument from their side.
One to watch. Alison, thank you. Alison Williams of Bloomberg Intelligence. Tom, to see the state of the banks, the financials, to see how well they've done, despite and maybe even because of what we've seen over the last year, because of the stimulus response we've had, it's just remarkable. The nature of the shock that we've just experienced, so different to what we experienced 10 years ago. And the success of these names on Wall Street, so different as well.
Well, the ratios are there, but I'll go right back to the beginning of it. And John, this is while you were away. Shonali Basak walked into my hermetically sealed studio here, and we both looked at the single headline that came out early. Lisa, I know, remembers this moment, where it was 24% tangible common equity for JP Morgan. John, I don't believe I've ever seen that number. That shows a prosperity that is jaw-dropping.
That was your final dig of this Tuesday. I'll be back tomorrow.
Oh, but there's Wednesday.
I'm going to step away. I'm going to step away a little bit earlier to gear up for a program.
Oh, the Green Parrot opens in 4 minutes. That's good.
Yeah, we'll be having drinks as we bring back the countdown to the opening bell with myself, Jonathan Ferro. Remain Bostic live to you all. The most watched program actually starts in about 18 minutes' time.
Oh, there it is. That's
From New
good
York
to know.
City,
The Dow
for
up
our
203
audience worldwide.
points.
This is Bloomberg.
With the First Word News, I'm Karina Mitchell. Janet Yellen will have a different task than she's used to when she goes before a Senate committee today for her confirmation hearing.
As you can see, position closed on Japanese yen. Just right here. So we have another profit.
Meanwhile, the Biden administration has rejected a move by President Trump to rescind travel bans on non-American citizens arriving from the EU, UK, and Brazil. The bans are aimed at preventing the spread of the coronavirus. President Trump said the bans could be eased safely, but Biden officials say they plan to strengthen public health measures around international travel. President Trump's approval rating has dropped to 34% in a new Gallup poll. That's a low point of a presidency that's already had the weakest average approval rating of any of his predecessors since the survey began in the 1940s. The president's approval rating has fallen 12 percentage points since before the election. In Italy, Prime Minister Giuseppe Conte faces a crucial test. There is a confidence vote in the Senate a day after he won a similar vote in the lower house of Parliament. A narrow win in the Senate would allow Conte to stay in office even if his support falls short of an outright majority. And Tesla has begun delivering the first Model Y SUVs built in China. It's the second locally built electric vehicle Tesla has sold there. Last year, the Tesla Model 3 was China's most popular electric car. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
China continues to be, recovering well. And with the opening up that was decided at the last 5-year plan, that is a golden opportunity for many international banks.
So we'll look to double our footprint across IB and also wealth management and asset management in the 3 to 5 year time frame.
Growth outlook structurally is very strong. But it does need to consolidate and allow time to help the share price appreciation to move more in sync with the growth.
So China can avoid further decoupling if they stop these inappropriate actions.
But at the moment, we really want to see the dust settle first on international relationships, on China's role in the global economy.
I don't see a likelihood of a big change in the policy with the change of administrations.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
issue of getting 100 million doses in the first 100 days is absolutely a doable thing. What the president-elect is going to do is, where it need be, to invoke the DPA to get the kinds of things we need, whatever they may be.
Dr. Fauci, moving on to another administration, and we congratulate him on that. Of course, we have tried as best we can, Jonathan Farrow, Lisa Bramwitz, and Tom Keene, to bring you adults in this discussion of this horrific pandemic. Grace Lee is at the Packard Hospital of Stanford University, their School of Medicine, I should say, and the Stanford Children's Hospital after a tour of duty at the acclaimed Boston Children's Hospital and out of Pennsylvania Medicine. And we're thrilled that she could join us right now. Dr. Lee, those of us of a certain age have the giving of a vaccine as being a doctor's office with a cold thing in the corner, or maybe not, or maybe it was drops of polio. How do you envision the vaccination of those younger in the coming months?
Well, we're really looking forward to having the ability to have information around the safety and efficacy of at least our teenagers, 12 and older. Currently, we're able to vaccinate those who are 16 and older when those phases become available to us to be able to vaccinate at a local level. But imagine that we're going to need to continue to push for vaccine clinical trials in the younger age group. Mm-hmm. It's going to be really important for us to be able to, protect all of our kids and adults and our older adult population as effectively as possible.
Do you assume that we will be using these new modern vaccines, the mRNA vaccines, or do we await something more conventional, something more traditional?
I mean, much like the development to date, my perspective is that we need to have a diverse portfolio to ensure that we have candidates that are potentially viable to be able to protect the younger population. So, testing the mRNA vaccines, and those are anticipated to go into, hopefully, trials down to age 6 months. But I also anticipate the other vaccine candidates, we hope, will continue to be in development for that population. We're going to need as many vaccine candidates as possible in order to get anything in a timely way.
Dr. Lee, can we get to herd immunity without children being vaccinated?
Well, so children are known to be able to be infected and also potentially, asymptomatically be infected. So I think that is continuing to be a challenge. In general, although children are less likely to have hospitalization or severe disease, we do see severe disease happen, number one. But number two, I think it is going to be important. While we can also employ all of our other mitigation strategies, specifically for the younger population, elementary school, we're still going to need options in order to be able to get back to a new normal. We are going to be wearing masks and doing social distancing and cohorting for a long time until we have those tools available.
There's also a question going forward about enrolling enough kids in some of these studies in order to get the data necessary to roll out the vaccine. Are you concerned about the safety, considering the fact that younger individuals don't get as sick from the virus and perhaps are a little more reticent as a result to go in and get jabbed by a new vaccine?
Safety is always going to be the number one priority, especially in the younger age group. Agree that the benefit-risk balance will be different for younger kids than it is for older. But, we not only get vaccinated to protect ourselves, but also to protect our family members and loved ones. I do think that the trials will emphasize, for sure, the safety profile of these vaccines in younger children. I anticipate that it'll be more challenging to evaluate to the same degree efficacy as quickly as we were able to do in the older adult population. But there are, immunobridging studies that are anticipated to be able to understand whether or not the immune response in young children is robust and can be as effective as we've seen in the older adult population.
Dr. Lee, John Lauerman and Jason Gale did a terrific summary a day ago on the global set of small shocks with big effect where they really damage people, etc. For our audience on radio and TV now, how would you describe the risk of shock and what we need to look for in the minutes following a vaccine?
Oh, regarding anaphylaxis, all of our vaccination clinics have protocols in place to monitor everybody for 15 minutes, so everyone should anticipate that after a vaccine, but 30 minutes for those who have a prior history of a severe allergic reaction. And individuals who, for example, carry an EpiPen, are number one. We do screening before they come to make sure that they are eligible and can receive the vaccine safely. There are still individuals who we want to make sure we provide access to vaccine because there are many people with food allergies or environmental allergies. And so we will continue to monitor those individuals more closely per our protocols, and all clinics are prepared or asked to be prepared, any vaccination clinic providing COVID vaccines, to be able to manage, monitor, manage, and then effectively be able to get those individuals to care as quickly as possible. It is a challenge with this particular vaccine.
Grace Lee, thank you so much. Dr. Lee with Stanford, of course, here, their children's hospital on the path forward with the vaccination. Lisa, it is truly a weekend in our history, all sorts of discussion about a Washington under siege, about the different themes of those arrested and such from the riot, but also about the economy forward. And we do await Secretary Yellen, maybe like we never awaited Chair Yellen.
Yeah, getting a sense of how she operates as a political operative, not just an apolitical appointee as the head of the Federal Reserve. There is a question of what line she will toe in terms of encouraging spending and how much she emphasizes this K-shaped recovery, Tom. When you talk about this weekend and this sort of pivotal aspect of it, a lot of the economic data has been devastating for the lowest tiers of earners out there. And the question is, what can she as Treasury Secretary do about that she could never have done as the head of the Federal Reserve?
Well, the balance here is, they're going to get a stimulus out. Who knows what that number will be? Widely presumed to be less than the proposed 1.9 million. They'll dispose of that. Trillion, excuse me. I can't focus. The Dow's up 208 futures points. But, Lisa, what's important to me is right away they have to start with the second idea, which wrapped around infrastructure. If you can't do infrastructure, Lisa, with a Democratic president, House and Senate, when are you going to do it?
Yeah, and the fact that infrastructure spending is going to be on the table. Also, the minimum wage proposition, and this is really a compelling one, this idea of doubling it to $15 an hour. Well, I think that it's a controversial point. I think that the economic statistics seem to point to a higher wage being beneficial for the economy, but there's a lot of opposition as well. Interesting, though, to see how much Republican support there will be for this measure, given the economic support for it.
We will see, and of course, so much of that, folks, goes back to the national sense of a minimum wage versus a state-to-state battle. On Yellen is chair. On Yellen is Secretary of Treasury Alan Blinder. Look for that. That's coming up as well. Please stay tuned on Bloomberg Radio. It'll be the same old program. On Bloomberg Television, rumor has it, Pharaoh is in the house.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City, for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell. Equity futures up 0.6%. We begin with the big issue. Investors preparing for Secretary Yellen.
Market-determined exchange rates will probably be the main emphasis coming from Janet Yellen.
And that's almost like a boilerplate comment that she almost has to make.
Whether or not the U.S. would continue to support a strong dollar policy.
Policy dynamic in the United States is one which is really pointed towards dollar weakness.
They ideally would want a weaker dollar.
How we get there is the stimulus that we're going to see should start to push inflation.
We're probably going to hear something about the stimulus.
What happens with the fiscal package eventually?
Yellen may be, Christmas coming for the market.
So it really depends on what Janet Yellen mentions.
The market is thrilled about the near term because the likelihood is we do get a large stimulus.
She's also starting from a point of having used the credit card all the way to $23 trillion worth of debt.
We're proposing even more deficit spending.
Joining us now, Michael McKee, on the latest down in Washington, D.C. Mike, we've heard so much already. What are you looking for?
Well, this is really a question of when, not if, for Janet Yellen's confirmation. After all, she's a known personality in Washington. She has been confirmed 4 times by the Senate already. What it really is, John, is an opportunity for her to lay out the Biden program in front of people who are actually going to have to vote on it, because there's a lot in there, and even Democrats aren't on board with everything the president-elect wants to do. So issue 1, how does she handle the transition from being above politics as Fed chair to the face of politics for the Biden administration as it tries to pass this next support plan? Yellen does bring credibility to the table as the former Fed chair and as a very well-known economist. In her prepared remarks, she's going to say, without further action, we risk a lengthier, more painful recession now and long-term scarring of the economy later. Now, the jobs report, the latest jobs report we got, certainly supports that. When you look at a chart of the unemployed, you can see that right now we are still about where we were at the peak of the Great Recession. A lot of people still out of work. And that's a reason Yellen will say to spend now, because interest rates are very low and the country can and must afford it. Neither the president-elect nor I, she says in her prepared remarks, propose this relief package without an appreciation for the country's debt burden. But right now, with interest rates at historic lows, the smartest thing we can do is act big. Other topics likely to come up: how do you pay for it? The mechanics of issuing the debt. A lot of people on Wall Street want to know if she would term it out, go longer term, maybe even introduce a 50-year or 100-year bond. Wall Street's been reluctant to see that. Whether the economy needs the Fed lending programs that current Treasury Secretary Steven Mnuchin canceled. And every Fed reporter's dream. What does she think about the dollar? She spent her years at the Fed saying that's the Treasury Secretary's job. The Biden mantra seems to be that the currency is set by the markets, and we respect the markets, and we will not devalue the dollar for competitive advantage. But it's going to be really interesting to see not just how she does, but the kind of reaction she gets for her proposal. We know they like her, but for the Biden proposals up on Capitol Hill.
Well, let's talk about that, Mike. It's been an ugly couple of weeks down in Washington, D.C. We're all aware of that. Do you expect any of that ugliness to bleed into the hearing that we'll hear in about an hour's time?
No, I don't think so with Janet Yellen's hearing. I mean, there are 5 nominees on the Hill today and some others maybe more controversial, particularly in the national security areas. But Janet Yellen is known and respected, and people on both sides of the aisle know something needs to be done. We're talking about how much rather than whether in this case.
Michael McKee on the latest down in Washington, D.C. That hearing coming to you live on Bloomberg TV and radio in around about 1 hour's time. Equity futures up 25 on the S&P 500. We advance about 0.7%. More stimulus down on Capitol Hill. A Federal Reserve that won't step in and a market that keeps climbing higher. Joining us now is Aaron Brown of PIMCO. Aaron, always great to get you with us on the program. Let's just start right there. A question that I asked Mike a couple of minutes ago. We know a lot already. What haven't you heard that you want to hear?
I think there's 2 key things that the market's going to be really looking for is one, Janet Yellen's comments on the dollar. And I think your previous speaker is right, which is that I don't expect that Janet Yellen is going to deviate from the mantra that the market should set the price for the dollar. So even despite the weakness that we've seen of late in the market, I think that we're continuing to see the dollar on a weakening trend. The second big thing is on stimulus, clearly, and we had earlier comments already released saying or suggesting that Janet Yellen's going to emphasize going big on stimulus, that now is not the time to start ratcheting back on stimulus. But that's really what the market's waiting to hear, confirmation of that, and any comments around how ultimately the government will pay for that. So the market really wants to see that the stimulus is going to continue for some time.
Aaron, a couple of market themes we need to tease out here. You started with FX and then you shifted to the bond market. Let's start with foreign exchange as well. What we're seeing right now play out is a better vaccination rollout in the United States versus Europe, a bigger fiscal impulse in the United States versus Europe, and the potential for growth differentials to really lean in the United States' favor. At the same time, you've got this big short position on the US dollar, a crowded trade reflected in the Bank of America Fund Manager survey that came out this morning. Which way are you leaning in foreign exchange right now, Aaron?
I do think that the pace of the decline of the dollar will slow from here. And importantly, I think it's going to diversify from here. So in the beginning, really starting in the third quarter of last year, we saw the dollar start to depreciate mostly against its larger trade-weighted currencies like the euro and to some extent like Aussie dollar. So mostly developed market currencies. I think from here, we're going to see a shift where you're going to start to see the dollar continue to weaken a little bit against developed market currencies, ex-US, but it's going to shift to also being a trade more diversified across emerging markets as well. So while we're short the dollar and remain, underweight the dollar across portfolios, we have shifted that from predominantly a trade against developed market currencies and widening that out to now include some emerging market currencies as well.
Has your call on the bond market shifted as well, on the treasury market, on duration, at the long end?
I think from here, again, the pace is going to slow as well. We're not going to see the same sell-off in rates that we saw really accelerate in the fourth quarter of last year and into early 2021. I think the dollar, I think that the rates from here against a 60-40 portfolio or an asset allocation multi-asset portfolio is actually attractive on a relative yield differential basis. And I do think that the rates are going to be fairly range bound for the duration of this year. So while we may, see some further weakening later in the year, for now, I think that the rates actually looked relatively attractive to buy in terms of duration.
So Aaron, just to build on what's happened in the treasury market late 2020 into early 2021, how do you see things in the bond market right now? Do you see the supply story driving high yields, or the idea that supply achieves and fuels better fundamentals in the future? What's the more important factor in the bond market right now?
What you saw really in terms of the sell-off in rates over the last couple of months has really been inflation or break-even driven sell-off. So break-even or inflation measures in the economy have been moving higher, and that caused nominal rates to sell off. Real rates haven't moved too much off their lows. So this really has been the expectations of higher stimulus driving higher inflation and that, begetting better growth. And that's not disruptive broadly for risk assets. I think what would be much more disruptive for risk assets is if we were to see real rates moving higher, really accelerating higher and outpacing that of growth expectations. But we haven't seen that of late. So for now, the bond market remains fairly well contained. It's been stimulus-driven, inflation-driven sell-off, and I think that actually begets a healthier market overall.
And as you say, Erin, that complements what we've seen in the equity market, the outperformance in the more cyclical parts of the market through much of the back end of last year. Erin, I want to finish on this. Last year we spoke a lot, and I think the challenge for you and others was the idea of whether to re-risk and really start to put on that cyclical exposure. And some people waited too long. What do you think the challenge for 21 is going to be?
Well, that is a tough question. I mean, I think really what it's going to be is this interplay between better growth, a recovery in terms of the pandemic, sort of concerns in the economy, and what that ultimately means for the rate trajectory, both in the U.S. as well as across developed market economies. And you started to see that play out a little bit at the beginning of this year, where there have been concerns that higher or better than expected growth and more significant stimulus would ultimately lead to higher real rates. And that played out over the last couple of weeks. But I do think that particularly as we get into the second half of the year, the market's really going to be clued in on when the Fed is going to start to taper. To date, Clarida as well as Powell have been pretty ardent and pretty, stated pretty clearly that they don't expect tapering this year. But I do think that the market's going to test that a couple of times. And then the second, also significant, I think, sort of policy focus is going to be on Biden's 100 days and ultimately whether or not he'll do anything on taxes or on healthcare reform. So I think those are going to be the key drivers for the market this year.
Looking forward to the conversation through the year with you. Erin Brown, good to see you joining us from PIMCO. Let's get back to these markets. Equity futures this Tuesday morning drifting higher after a long weekend on Wall Street. We get back to work and we add some weight to the S&P 500 with your movers. Going into the opening bell about 19 minutes away. Here's Sarah Ponczek. Hey, Sarah.
Hey, John. I'll kick it off with those banks. Earnings continue to roll in. And if you look at share price performance this morning, it does look like a bit of a mixed bag. Bank of America down 1.3%. This after overall they did beat on earnings, but they missed on revenue. Revenue from sales and trading rose 7% to $3.06 billion in the fourth quarter, but that missed analyst forecasts of $3.15 billion. Then on the flip side, you see Goldman Sachs higher by about 1.8% this morning, a beat on the top line, a beat on the bottom line. Also, strong investment banking revenue numbers, and stock trading delivered a 40% revenue increase. Let's also take a look at those big tech companies and social media companies, because we had seen them come under pressure last week. They were caught in the political crossfire. Well, today you see Apple, Facebook, Twitter, all pushing higher. To give you some perspective, Twitter last week was down 12%, Facebook down 6%, Apple down close to 4%. I also want to highlight Netflix, of course, because Netflix will be reporting after the close today. And last but not least, take a look at some of those travel and leisure companies, because even though we do see tech pushing higher, we see airlines and cruise lines pushing higher as well. American Airlines, Delta, Carnival, Norwegian, all higher by more than 1% in the pre-market trade. More perspective here, my reopening basket that I track of names of these sorts, also some hotel groups too. It's been up 3 weeks straight, John.
Sarah Ponczek on the latest movers. Sarah, thank you. Much more from Sarah through the hour and through the day on Bloomberg TV. Counting you down to the opening bell. Earnings season just about getting into full swing. We'll break down the banks, the earnings still to come, and we'll get the call from Jack Manley of JP Morgan Investment Management. For our audience worldwide, back in New York City, and I have to say I am happy to be back. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
We do believe that 2020 borrowed some of the returns from 2021. We do think stocks will be higher in 2021, but less than earnings. Our guess is the earnings will be up more than 20% with another fiscal package that might be 25 or more. But we think the stock market will not keep up with earnings.
Bob Dole of Nuveen on the outlook and a high bar coming into 2021. Earnings season gearing up. About 10% of the S&P 500's market cap reporting this week. Energy, the financials getting their first test. On the story is Katie Lyons. Hey, Kaylee.
Hey, John. Well, we know big banks kicked off earnings season with more of a whimper than a bang on Friday. JP Morgan, Citi, Wells Fargo, all disappointing the market with their results. And the same is true for Bank of America this morning. The shares are lower by about 1.5% in pre-market trading. And you did have fourth quarter trading revenue falling short of expectations, hurt by weakness in fixed income. Investment banking did beat estimates. The bank joined its peers in releasing reserves, but still the stock is lower, as are the shares of State Street, which also reported this morning. Goldman, though, bucking the trend, rising 2% after its results. Beats across their units, a 40% surge in equity trading, 27% surge in investment banking revenue. And a big highlight here, net income doubled, John. Goldman joining the ranks of all of the big banks that have reported with higher net income sequentially in the fourth quarter than in the third. Basically, big banks are still raking in profits, even with a pandemic that has put millions of people out of work. And of course, John, we know the pandemic did have a big impact on corporate profits more broadly, the bottom being in the second quarter of 2020, earnings knocked down by nearly a third. But the climb back is expected to be relatively steady. Earnings between the fourth quarter of last year and the current quarter expected to be basically flat, but analysts expect profits to surpass 2019 levels starting in the third quarter. It's that back half of the year recovery this market has been looking ahead to for so long, John. Now, of course, in the more immediate term, we do get 42 companies comprising about 8.5% of the S&P's market cap this week. As you said, that's mostly financials and energy, but it is next week, John, that is the big one, the busiest of the season. 126 members of the S&P will report, including Apple, Amazon, and Microsoft, John.
Looking forward to the coverage. Kelly Lyons, thank you. Sometimes with the earnings season, with the bank earnings specifically, there's just one line that jumps out and gets your attention, and that happened this morning with Bank of America. This came from the CFO. We ended the year stronger than before the health crisis. We've talked a lot about scarring. Where's the scarring for some of these names? They have performed so well over the last 12 months. Looking forward to getting our teeth into that with Sonali Basak a little bit later this morning. We'll do that in about 13 minutes' time around the opening bell. Jack Manley at JP Morgan expecting two key factors to drive earnings season through the next 3 months. He says the following: investors should consider upcoming policy changes and the contained economic and market recovery in the wake of the COVID crisis. Jack Manley joins us right now. Jack, we had the winners of 2020. Will the winners of 2021 be any different to the winners of last year?
I think there's a lot of room for that to happen, John. I mean, 2020 was a year of winners. It was also a year of losers. And we come into 2021 with extraordinarily high valuations at an average level. But if you actually open up the hood, look under the surface of this, there are still a lot of names that are very compelling from a valuation perspective. They're inexpensive relative to the broader market. In fact, the valuation dispersion we're seeing right now in the market is the widest it's been in at least 25 years. It means that I think some of those losers, those laggards of 2020 will likely be at least partially some of the winners in 2021, although I wouldn't discount some of the strength in technology and healthcare to continue through the course of this year.
Jack, you touched on that valuation debate. Let's build on it. How unusual, how unique is it at this stage of the recovery, the very beginning of it, that we're having the conversation we're having about extended valuations?
I think it's pretty remarkable, but at the same time, John, I mean, what we've seen over the last couple of years, even not just in 2020, is that markets are very resilient and they bounce back very quickly. And so the fact that things roared back to life so quickly, I don't think is necessarily surprising given the broader context. I think what's also important to remember is that what we experienced last year was very much event-driven. It wasn't something structural. It wasn't something cyclical. And it means that investors, really since the start of the pandemic, have been able to look forward to a post-COVID reality. They've been able to see through all this mess, anticipate it, know that it's going to be here, look beyond that to what future growth entails.
And Jack, they've seen how quickly the economy snapped back as well. I know how hated the bull market in the last 10 years was, and I can tell you that the snapback we've seen over the last 12 months is more hated than the bull market for the previous 10 years. What's underappreciated, though, is just how quickly the economy snapped back when we reopened, Jack, and how underappreciated that might be through 2021 as well. Back end of last year, I heard all the calls about EM, Europe. We're coming to 2021. I just look at the United States right now. Janet Yellen saying, let's go big. Vice Chair Rich Clowder over at the Fed saying, I want nothing to do with this. If things get better, you won't even hear from me. I'm stepping out. I'm stepping away. Fiscal policy, monetary policy, firing. You've got the vaccination rollout in the United States that is going better than most of Europe as well. Can you have an overweight on Europe relative to the United States right now, given what you're seeing play out in the two economies, Jack?
You know, John, I think I'm going to be a little bit controversial here and say that I don't fully believe in that European story. I mean, there is a lot on paper for why Europe should outperform this year. The valuation argument is compelling. The income, the dividend story there is compelling. We do expect a falling dollar throughout the course of this year. All of those things are going to be helpful for Europe, not to mention the fact that it is a more cyclically composed market, cyclical economy. But there's a lot of headline risk in Europe. I mean, what was it? Last week, we started to hear about Italy going through a new political crisis. I mean, you know, we had been maybe 12, 13 months without hearing about one of those. Europe has a lot of issues that they have to get through. And I don't think the fact that there is this cyclical tailwind here is necessarily going to overcome all of those. Now, we can be very, very tactical in where we allocate to Europe. I like luxury goods, for example, but I still very much like U.S. markets in 2021. I also think that we can take more risk in emerging markets, particularly in EM Asia, John.
It seems to be a weak dollar underpinning a lot of this for you, Jack. I'm trying to understand what is going to drive that weak dollar, given the conversation we're having.
Well, I think we look at a dollar that has been persistently overvalued for really a long time, and a lot of that has to do with the trade deficit story. The U.S. economy, or the U.S. consumer rather, just floods the global economy with dollars every single year. That should inherently be dollar negative. But the things that have propped up the dollar recently have been a pretty wide interest rate differential and a whole lot of fear associated with the unknown. I mean, 2020 was certainly a year marked by that. We've seen that interest rate differential narrow, and it will likely stay narrow for at least a little while longer. And certainly on a relative basis, I think a lot of that fear has abated. These things should allow the dollar to drift lower. I don't know if we see it fall by 10, 15% this year, but anything helps when you're a U.S.-based, dollar-based investor allocating overseas. But you're right, John. I don't think it's guaranteed.
Jack Manley of JP Morgan. Jack, always great to catch up, sir. And the FX market this morning through G10, a weaker dollar through the bulk of G10, the exception being the Japanese yen. In the equity market, equity futures higher. We have a rally in the US equity market ahead of that hearing from Janet Yellen. Full coverage on Bloomberg TV and radio through the next through hours. From New York City, for our audience worldwide, up next, we'll get you some morning calls, some of the analyst action, and later, Baird banking analyst David George on the big banks on Wall Street. This is Bloomberg.
their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Janet Yellen's the focus. You'll hear from her on Capitol Hill in about 30 minutes' time, 45 minutes' time. We'll take that right here on Bloomberg TV and radio. Going into the opening bell this Tuesday morning. Good morning to you all. Equity futures up about 27. We advance 0.7%. Let's get you the morning call, shall we? A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Barclays. Downgrading Viacom CBS to underweight from overweight, a $35 price target. The analyst citing valuation, seeing limited upside at current levels. Next up, Citi, adding Harley-Davidson to its 30-day catalyst watch list. The analyst expecting management to provide clarity by revealing its strategic outlook. And finally, BMO upgrading Facebook to outperform with a $3.25 price target. The analyst saying political and antitrust risks are now priced into shares following a recent pullback. For our audience worldwide from New York, the opening bell is up next. This is Bloomberg.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I mentioned this a few times already this morning. Let me say it again. Get your head around this. Year-end call, SocGen, Citi, Bank of America, Stifel, 3,800. Have a little look on the screen. S&P 500 futures, not far away from that. Futures up 26. We advanced 0.7%. Going into the opening bell, gains on the screen. Switch up the board and get to the bond market. Treasury yields are higher. The curve is steeper, up 3 basis points on 10s to 111, on 30s to 186, as we wait for Janet Yellen to become Secretary Yellen after being Chair Yellen for the last several years before Chair Powell. Let's get you the story in the equity market. The opening bell this Tuesday. Here's Kelly Lyons.
Well, John, I want to start by checking out the shares of Tesla. Just get it out of the way. The stock is higher by about 1.5% at the bell. A couple things going on. One, you have deliveries of the China-made Model Y starting. And the other hand, you have a price target upgrade over at Jefferies. The analyst there raising his target to $775. Note, though, John, the shares trading around $836 this morning. Also higher on analyst action is Facebook, and raised to equivalent of a buy at both Monness, Crespi, and BMO. BMO saying advertising headwinds are set to expire. KeyBank also raising its price target on the stock, which is up by about 2%. Elsewhere in tech, Apple, the big leader in the NASDAQ 100, and Plug Power, the big leader in the Russell 2000, both rebounding this morning. Plug, of course, fell 14% over the last 2 sessions, now up about 4.5% in this Tuesday trade. Apple higher by about 0.8% after falling in 4 of the last 5 days. A few other stocks on the move for you, John. Coherent, which is prominent in aerospace and defense and microelectronics, is surging about 30% after getting a $5.7 billion bid from Lumentum. That's a 49% premium to its Friday close. Lumentum, for its part, though, is lower by about 8%. Western Union also higher to the tune of around 2%. John, Walmart opening in 4,700 stores that money transfer service. That's giving a nice lift. And we saw a look at those banks, John. Bank of America and Goldman heading in 2 very different directions after their fourth quarter results, John.
Kelly Lyons, thank you. Much more from Kelly a little bit later this morning. About 2 minutes into the session, 3,800 on the S&P 500. Basically bang in line with some year-end targets from some big names on Wall Street. Who moves first? Looking at the price action right now, energy, industrials, communication stocks leading the way. Energy up by about 1%. The benchmark, the S&P, up by 0.75%. Banks kicking off earnings season. RBC's Jared Cassidy reacting to the results, saying Bank of America is well positioned for growth through the next year.
Credit reserve releasing will be very dominant, and that's going to drive earnings. It's going to drive tangible book value per share growth. It's going to drive share repurchases. So as much as people may want to focus on trading, for Bank of America, it's all about credit.
Jared Cassidy of RBC joining us now. Shonali Bassett wrapping up the results. Hey, Shonali.
John, hey, you have some good news here. You see a stronger consumer. That's what Gerard there was speaking to. But you also have some concerns on the horizon for the big consumer banks. That loan demand is starting to be concerning for people, as well as rising costs. Bank of America right now is speaking to analysts, and the first couple of questions came about their efficiency ratio, which we see rising. There are costs tied to COVID. There's costs tied to child care for their employees, and costs tied to the PPP program. You move over to Wall Street, you have a different story. You have a much brighter picture ahead from Goldman Sachs, which has record net revenues. That's record net revenues in its investment bank in a pandemic year. They have this record equity underwriting and also very high numbers in debt underwriting. Both of these banks fell a little short on fixed income, but Goldman Sachs has through the roof equity trading, even higher than JP Morgan, which puts a lot of pressure on Morgan Stanley tomorrow, which we want to see perform in that rate as well.
Shonali, we've become almost desensitized by the numbers. I know you haven't. Can you just give me your take on these figures, some of these record profits coming out of these well-known names in a pandemic year?
It's shocking, John. You have unemployment numbers one day telling you that 18 million people are on some form of jobless aid. Then the next day you have JP Morgan saying that it had the best quarter in its history. We have Goldman Sachs posting revenue here at its investment bank that's better than we've ever seen on so many fronts. Consumers and Wall Street are going in 2 different directions here. When they get into the Biden era, how are the regulators going to grapple with that? Are these banks indicative of the broader economy?
And how big will the voice of Elizabeth Warren, Senator Warren, be in this incoming administration? We haven't heard much about that yet. Shonali, thank you. Shonali Bassett, much more from Shonali through the week on the financials, the earnings from Wall Street. Here's the take from Baird's David George, remaining constructive on the banks. He writes the following, quote, sentiment on financial stocks has broadly improved and absolute valuations for banks are migrating closer to fair value, but we believe skepticism is high enough and relative valuations are reasonable enough to stay constructive on the bank group going into the new year. David George joins us right now. David, talk to me about that just to begin with. The conversations you have every day with clients, do you still sense that skepticism around this industry, around this sector, this group of names?
Hey, John, good morning. There's much less skepticism today than there was when we got very constructive on banks back in the March, April of 2020 timeframe. So there's increased comfort, John, as it relates to the tail risk, as it relates to credit and the COVID related impacts to that. And there's still, from our perspective, enough skepticism about the growth potential and capital return prospects that we think, on at least on a relative basis, that the banks look fairly reasonable on a risk-reward basis.
David, let's talk about capital returns. We saw a huge reserve build last year. Now we're starting to see reserve release and the buybacks and a boost to capital returns that a lot of people anticipated. What I'm trying to understand is whether we've seen a one-off snapback, a change in that story, a squeeze in some of these names, or the beginning of something more durable that lives through the cycle, through the next several years, 5 years and beyond. David, what's the cycle call for you? And I know it's premature, but I just want to try and understand your thinking, the framework for approaching that question at the moment.
Yeah, it's a fair question and obviously a relevant one. As we're thinking about the next, say, 1 to 3 years, at least from our perspective, John, this is going to be more of a what I would call a utility-like emergence from this crisis. In other words, fairly slow balance sheet growth, which as a result, and fairly good profitability and reserve releases, which lead to fairly durable and consistent earnings, as well as fairly significant capital return at the same time. So I think it's foolish to expect a significant amount of loan growth, given how liquid bank balance sheets are. They're as liquid as they've ever been. As an example, Bank of America, John, had 26% deposit growth on a year-over-year basis. This is the largest depository in the U.S., so that's just an unbelievable number. So, but at the same time, profits should be fairly good, and capital return and fairly durable earnings, I think, take us that next leg higher.
What about the political headwinds down in Washington, David? How are you thinking about that? Shanali touched on it just briefly, and I just wonder to some degree whether they will be a victim of their recent success, whether it puts them in the focus, in the spotlight down in Washington in a way that maybe they don't want to be.
Well, it's always a risk, but I think the risk has been mitigated by a couple things, and obviously, as you say, John, it's unpredictable. But Janet Yellen, from our perspective, is obviously very much a known commodity. She's very familiar with the banking system, the risks that the banking system take, and the actual risk of the sector today versus 2008, 2009 is just not even in the same ballpark. You've got capital that's almost tripled. Liquidity is much better. So I feel like the risks in the system are much less, and you've got fairly good familiarity in Washington with the banking system and the risks that they entail.
David, just to build on that, to reflect on the last crisis and the nature and character and how different it was, what do you think is the least understood, just in the chats that you have at the moment? The nature of the shock that we've just experienced in the last 12 months versus, say, 10 years ago, or just how much these business models have changed on Wall Street from where they were 10 years ago?
Well, that's kind of two separate questions, and the second one first. I think as it relates to the changes in the business model, the reality is most of these companies, and this is the regulatory framework that I kind of referenced a moment ago, the actual risks in the banking system are much less than they used to be. And as a result, I think there's less risk in these business models broadly. In terms of the misunderstood risks, you know, I think the big unknown, John, is how good is credit quality underneath the surface. We obviously had a once-in-a-100-year pandemic, a record amount of stimuli that's been thrown at consumers and businesses. And once this starts to kind of dissipate and subside, that stimulus, and it will, I think there's still an open question from a credit quality perspective. You know, what do we really have? Where are the risks? What are the intermediate term impacts on things like commercial real estate and certain businesses that may have a little more longer term impact resulting from the pandemic we've been living through?
David, come back soon, because I think that topic that we've just finished on is something we need to focus on a whole lot more for the months to come. David George there of Baird. Great work as always, David. I know you've got a busy morning and a busy week ahead of you, so thank you for your time. In the market right now, about 10 minutes into the session, equities up 0.7% on the S&P 500, 1 full percentage point on the NASDAQ. With your movers 10 minutes in, it's Katie Lyons.
Well, John, I want to start off with the shares of GM. They're higher by more than 7% in the first few minutes of trading. This after the company and Microsoft are leading a $2 billion investment round in Cruise, the self-driving car startup. That funding values Cruise at $30 billion. And of course, GM was already a majority owner. You also see AstraZeneca on the rise. Its COVID vaccinations in India are set to begin this week. Also some commentary out of an analyst over at Handelsbanken who says the company will have the most dynamic first quarter in pharma. That stock is up around 2%. A bigger move for EW Scripps, though, popping higher by about 4.5%. This after Warren Buffett's Berkshire Hathaway reported a 25% beneficial ownership of the company via warrants. That's after Berkshire, of course, made a $600 million investment in the company to finance the purchase of Ion Media. And then finally, check out GameStop, John, surging a whopping 17%, rebounding from an 11% drop on Friday. Its total in the past 6 sessions up more than 130%. That's after activist investor and the founder of Chewy, Ryan Cohen, took a stake in the company last week. Clearly, investors hoping he's going to be able to make some change, John.
Kelly Lyons, thank you on the latest movers. Coming up next on the programme, we'll catch up with Kevin Cirilli down in Washington, D.C. Were you confused as I was yesterday evening? 1 minute the travel ban has gone, and then it's not gone anywhere. It's the President Trump administration making their move and the incoming Biden administration seemingly saying no. Kevin's take up next on the programme. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We want to ensure that every single person who needs a vaccine gets it, anywhere in the world. No country will be safe, and no economy will truly recover until the virus is under control in all continents.
That was the EU Commissioner on the vaccination effort in Europe, and I have to say that vaccination effort is lagging behind what we've seen in the United States. A difficulty on the continent at the European level to acquire the right amount of vaccines to distribute across the whole continent, and some countries eager to go their own way. At the same time, we still have a travel ban between the United States and Europe. We thought maybe that travel ban would be coming to an end after an announcement from the Trump administration yesterday. Literally within the hour, the incoming Biden administration turned around and said no. Joining us now from Washington is Kevin Cirilli for a whole lot more on that saga that lasted about 5 minutes. Kevin Cirilli, what is happening and what happened yesterday evening?
Jonathan, the only way I can put it is policy ping pong. And in fact, the Trump administration, outgoing Trump administration, had said that on January 26th, they were going to lift the European travel restrictions. Then, as you just mentioned, 5 minutes later, Jen Psaki, President-elect Joe Biden's communications director, puts out a tweet. And in the tweet, she writes, quote, "In fact, we plan to strengthen the public health measures around the international travel in order to further mitigate the spread of COVID-19. With the pandemic worsening and more contagious variants emerging around the world, this is not the time to be lifting restrictions on international travel." Either way, that now off the table, this, as we're just now really 24 hours away, plus some change in terms of President-elect Biden being sworn in. And we are hearing, based upon whom I'm talking to and other reports, that the COVID-19 restrictions are going to be front and center in terms of vaccination rollout as well.
Kevin, I think we've got to talk about what change is on day one in a Biden administration and how quickly things change as well. What should we be focused on day one, how quickly policy can change and where?
Vaccines, in terms of emergency use authorization, in terms of mass planning for vaccination rollout, in terms of using public facilities, large-scale public facilities, and working with the states to make sure that the inoculation efforts are coordinated with the states and the federal government. From an economic standpoint, fiscal stimulus, $1.9 trillion. We're going to hear a lot about that in Fed Chair Yellen's testimony underway on the Senate. Of course, she's tapped to be Treasury Secretary. And then geopolitically, look to see whether or not the Biden administration is going to make any decisive action as it relates to energy, as it relates to North Korea, and yes, of course, China as well.
Kevin, thank you. Great work as always. Kevin Cirilli there, down in Washington, D.C. Joining us now, Salita Marcelli, UBS Global Wealth Management, America's Chief Investment Officer. Salita, fantastic to get you back with us on the program. Let's just start with this story down in D.C. A recovery that has hardly got started. Politics, incredibly divisive, perhaps more so over the last several weeks. And here we are at the start of a recovery, talking about whether valuations have gone too far too quickly. Can you weigh in on that for us?
Hi, good morning. Yes, of course. So, look, I think, when you look at the valuations in isolation, they certainly do look historically high. But we have to look at it, within the context of, with the backdrop of the very low interest rates, because without that, if you just look at the market in general, you just see that there are preconditions for what a lot of people are calling a bubble. So those preconditions do exist. But we don't think that the equity market as a whole in a bubble. When you look at valuations with the backdrop of the low rates, what you see that is that actually they are around historical averages. One of the more popular measures of that is Shiller's excess cyclically adjusted price-to-earning ratio yield, and it certainly implies an excess yield for equities over bonds of about 3.8%, which is still pretty reasonable and makes equities attractive. And then you also have large parts of the market that are not expansively valued by historical comparisons. If you take, IT or IT-related consumer discretionary out, globally, price-to-earning ratios dropped over 20 times to below 18 times. And the last thing I'm going to say about that is, the leverage still remains contained in the market, and that's probably because the volatility was high last year. A lot of the hedge funds or risk parity funds were not able to pile onto debt. But the leverage, while it might increase rapidly, right now seems pretty contained. So we do think that,
Salita, just
there's
build
not
on
much
something
of a
that I mentioned earlier on in the program, and my apologies for cutting in because there's a little bit of a delay, so bear with me. How unique and unusual is it to have this conversation about bubbles, to hear almost the bubble in the bubble conversation at the very beginning of a recovery that, let's be honest, has hardly even got started yet?
It is actually, it is, pretty unique in the sense that, but I think it has so much to do with how quickly the market recovered over the last year. But it's also not just the equity market, right? That conversation around bubbles also exists within the context of the bond market. And we know that central banks have unlimited capacity to be able to support their policy right now. And then on the side, you have other places like the cryptocurrency market and other places where we see irrational exuberance. So I think when you pull it all together, it's reasonable to see why there's such a conversation. But when you look under the hood, I think, we are in a place where we could still be pro-risk right now.
One thing that you've said is that you can't observe valuations against the 2007 peaks without also observing them against interest rates and relative to where rates are right now. Salita, I think one thing I've been given a lot of thought to recently, though, is the low rate story that existed and persisted in Japan and Europe over the last 10, 20 years, in Japan specifically, Europe the last 10, and how little that actually did to stimulate equity markets. Is the United States going to be a different story, do you think? And if so, why?
Well, we are yet to see that. But I would say up until now, a lot of the fiscal stimulus that's been done was to keep the economy afloat, right? Try to avoid a number of bankruptcies, increase in default rates, and try to keep the economy going at a time when the pandemic did unimaginable damage. The key question is not so much the fiscal stimulus that we just got and we're about to get, but whether, after the pandemic, fiscal stimulus is still going to be there in an aggressive way to stimulate that inflation and growth. And I think, we're yet to see, but there are reasons why we do think that aggressive fiscal spending might be with us for a long time. Because first of all, you had with the pandemic nationalism and populism, which in itself sometimes requires a fiscal response to it. Right? And we also have not necessarily seen inflation picking up. I mean, the pandemic, it did not really create the disinflationary environment. Even way before the pandemic, central bankers have been encouraging fiscal authorities to press the pedals because we had weak demographics and we do have, other factors that have been here with us. So I think it is possible that we might move into a new paradigm where we might continue to get aggressive fiscal spending, and that might give us a different story than what we've seen in Europe and in Japan. There's a lot of risks there, but it is possible.
Salita, conversation you and I have got to continue. It's fantastic to hear from you. Great to have you with us back on the program. Salita Marcelli there of UBS Wealth Management, the America's CIO. Let's get back into the market, up 0.5% on the S&P 500. We advance about 20 points. Breaking down the sector price action is Sarah Ponzek.
Hey, John, early into the session, but 8 of 11 main S&P 500 sectors are higher if we take a look at the IMAP on the terminal, but not a value versus growth breakdown, but a clear cyclical versus defensive breakdown. So energy at the top, as you see, WTI crude oil at 52.56 a barrel as we speak. 10-year break-even inflation expectations, 2.11% now. At the bottom of the pack, your classic defensives, though, utilities, staples, and real estate, John.
Sarah Ponset, thank you. Up next on the programme, we'll run you through the trading diary as we count you down to Chair Yellen becoming Secretary Yellen down on Capitol Hill. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
About 25 minutes into the session, equities up about 0.5% on the S&P. We advanced 20 points on the Nasdaq, up 0.6%, up around about 86 points there. Early days this Tuesday morning. Let's get to the trading diary, what you need to be watching through this week. In just a few moments' time, Janet Yellen's confirmation hearing for Treasury Secretary set to kick off. Full coverage right here on Bloomberg TV and radio. On Wednesday, the inauguration of Joe Biden and Kamala Harris. The ECB delivering a rate decision on Thursday, and on Friday we get market PMIs from the United States and the Eurozone to close at the week. My first week back for 2021. Fantastic to be back with you. Continue the conversation with me on Twitter at FerroTV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
Continues to be, recovering well. And with the opening up that was decided at the last 5-year plan, that is a golden opportunity for many international banks.
So we'll look to double our footprint across IB and also wealth management and asset management in the 3 to 5 year time frame.
Growth outlook structurally is very strong. But it does need to consolidate and allow time to help the share price appreciation to move more in sync with the growth.
So China can avoid further decoupling if they stop these inappropriate actions.
But at the moment, we really want to see the dust settle first on international relationships, on China's role in the global economy.
I don't see a likelihood of a big change in the policy with the change of administrations.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque.
swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest-hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease beside disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. If you do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.